Okay, so let's take a couple looks at the dollar index, and let's begin with a daily chart. How many of you in here watched the video link I sent out? Now, in fairness, it's really pointed at showing the strong contrast to what I teach, what I trade with, in relationship to what is commonly known as supply and demand. Supply and demand is not an ICT order block as much as the pundits would like to say they are. They're not. The way a supply and demand zone is created and the way it's perpetuated by Sam Seaton or those online trading academy guys or whoever else subscribes to the view of supply and demand, they get you to a zone. Okay, and the way the ICT order block works is it gives you a specific level to look at, and then you round it to the nearest round number or institutional level, and that's why it's so precise. It's not leaving you to discern or guess as to where in a zone you want to trade at, and that's the fallacy in it all. And if you take it down to the bare bones of supply and demand, they have a large subscriber base to it. And while there are some that will show profitability, and I've said this in the past, supply and demand concepts, by and large, will get you to an area where trades will likely form, okay? But it will not give you the trade levels to trade at. It will not give you the X-ray view on how to narrow down to a specific price level, which is really necessary for obviously defining risk, keeping risk small, manageable, and also what level to shoot for in terms of a profit objective. So when I get tweets, I get emails, and I get other folks that'll come in and say, well, you're repackaging, regurgitating, and relabeling shit just to make myself look good. I've been doing this 23 years, okay, and I can tell you what I do isn't out there except for what I do. The way I teach it is all me. It's not. I didn't look at supply and demand and say, let me try to improve on supply and demand. I didn't do that. Supply and demand was actually shown to me by a guy on Baby Pips, my Baby Pips days. He was really trying to push hard and heavy about it, and I kind of was like hinting at him, saying, look, I understand where you're going with it, but I don't subscribe to that because it's too vague. Okay, remember when you first got involved with trading and the concept of support and resistance was introduced to you, and suddenly, because someone's showing you an example of a chart, it doesn't make a difference what time frame it was, but if they showed you a chart and they clearly show that the resistance worked in the past, and look how perfect it went right to that level again and turned around and went down, and then you tried to apply that shit to your charts and your trading, and what happened? You blew right on through it, and you had no understanding of why it did it. Okay, and that's the same fallacy that goes along with supply and demand, because really all you're doing is applying trend line analysis, okay, and the theory that price will bounce off of a trend line, okay, sloping up or sloping down, but you're just applying it to a zone, okay? There's no reason to base your assumptions on future price moves on a zone. A zone has absolutely no basis in your trading except for highlighting a potential killing ground, okay? An area where a trade most likely will form. But that is in no way narrowing down what your job is and fulfilling the role of you as a trader, because you have to select where you're going to get in at. And it has to be a level that makes sense, obviously. It has to be a level that is building on an idea that there should be institutional sponsorship at that price level, okay? It's not that you look at a zone and say, okay, well, and I'm going to finish this thought because I kind of already moved away from it. When you looked at support and resistance, okay, supply and demand is the same thing to that, but it just made it even worse, because you can look at a chart and say, okay, well, look, I looked at this level here, okay, and looking at this, we can see that price clearly went up to that level. In hindsight, perfect 2020, we can see price went up there and then it rejected and went away. Okay, so everyone knows that this right here would be deemed as a resistance level. Can you guys hear me? I got a couple people asking if, yeah. Yeah, I'm sorry if you can't hear me. It's going to be on your end, guys, but it'll be in the recording, okay? So looking at the idea of support resistance, okay, yes, I have a module that teaches specific levels and how to apply support resistance. But again, much like you probably discerned on your own as a fledgling trader, you found out that support resistance isn't the be-all, end-all. It's not the panacea of trading. Okay, the understanding of why the market should find support resistance there is the missing link. Okay, and supply and demand gets close to it. It gets you in the neighborhood, but it never gives you the address. Okay, it doesn't give you the access to the price level that you need to see where the institutions are going to come in and actually do the buying and selling. Okay, so if you really break it down and weigh my work, the ICT order block, which is based on real institutional trading, and I've done it. I've been in that field. Okay, I know what I'm talking about. I prove it. I show it to you, and the whole context of the MyFX book, which we'll talk about, and we're actually going to pull it up, is to show you that there are folks out there that will teach you and promise you future riches, but they don't ever teach you how to get out of the hole you dug for yourself before you found them, if you did in fact find a good mentor. Okay, many of you already know what it's like to be in drawdown and have had a hard time getting out of it, despite having good skill sets given to you and shared with you. The psychological barriers, the uh, routine and the process you got to go through to get out of it, okay, and the thought processes that's necessary to adopt to get through that. That's something that's not taught by anyone, okay? So when you get out there and you start looking at stuff and you see these guys come out there, they want to sound like smart asses. Well, you're repackaging and relabeling. That stuff has been thrown at me for 20 years, okay? And honestly, I've always encouraged it. Go out and really weigh everything I teach in the balances, okay? I didn't come out and say I invented support and resistance. I didn't come out and say I invented Fibonacci. I didn't say that. I never said that. I said I had all the access that you have as a new trader, okay, with all the retail stuff and indicators, and I weeded out all the bullshit and stuck with the things that worked, okay? I found that the Fibonacci level, 70.5, midway, okay, and I was just flirting around with it, okay? I noticed it didn't go to 79 a lot of times, or 78.6, and a lot of times it wouldn't just stop at 62, okay? It would just go right in the middle. And the 50% level is kind of like a real weird phenomenon, really. It's just like it likes to go halfway somewhere, okay? And that's why also I like to take my profits early too, because I don't like to see myself hold hard and fast to a specific level. Even though I think it may trade to that level, I want to get out before it gets there, okay? So when I talk about things and when I teach things, okay, you'll probably see a Fibonacci overlaid on my chart. Not so much anymore recently, okay, but if you look at my work, you'll see Fibonacci, okay? And it was a tool to help illustrate returning back inside of a range. That's all it taught. It just gives you a little crutch to find that little sweet spot to look for. But once you understand price action, you don't need any of that stuff on your chart. You don't need the moving averages to discern where institutional order flow is on the higher time frame, because you know by looking at the price action what it is. It's going up or down, okay? But when I see these asses get on there and they say, you're repackaging or relabeling, okay, first get one thing straight. I'm not selling you anything. Secondly, I don't care if you like what I teach. I don't care if you make money or don't make money. I'm doing this because I have a record of it for my children. You just are witnesses to it, okay? Believe me, if it was all about me, making money, selling books, which I made a smart remark about because some goofball, okay, on there, I made a snide remark, which everybody knows I don't sell anything, but he ran with it thinking I'm going to be, selling something down the road. I'm not selling anything, okay? I don't want anything from any one of you, okay? But I am interested to see what all of you do with it, and that's all I've asked for. So, but I'd like to come out here and answer some of these things a lot because I love my trolls. As much as you like to think I'm upset or mad or anything like that, I'm not. I love them. I absolutely love them. And I hope they stick with me because if I can convert one of them, that's what I'm looking to do. And they may do it in secret, but I know I'm going to get somebody eventually. They're going to be like, you know what, this guy, he really does tell it well, like it is. Okay, but their feelings are going to be hurt up to that point. But looking at the tools and the applications that I teach, okay, I have to take you out of the retail world, okay, but we have to find a common language, okay? All of us know what stochastic is. We all know what RSI is. We all know what support resistance is and supply and demand, okay, all those types of things. All of them have their place in trading. Now, what I'm about to say is going to be the distinction of whether you stay in the retail world or you move out and you go into the professional level mindset. All the retail tools that's on your MT4 platform or your Ninja Trader or TradingView platforms, all these things that are out there, we have all these toys at our disposal, okay? And just like a child, if you throw them in Toys R Us and you let them run wild, okay, they're not going to stick with one toy. They're going to jump and jump and jump and jump, and they're going to have a tantrum when you try to take whatever's in their hands at the time out. So I had to take every one of you from the baby pips days through this process of going through all kinds of retail tools, just like I did, and then finally showed you the fallacy in it all. Now, if I would have told you from the beginning, take everything off your chart and we're going to look at things like this, half of you would have been like, no way. I need these things. I need to have these things. These are my training wheels. These are my crutches. These are my things. These are my best friends. And it would have been a barrier to your understanding. And plus, I need you to be in the charts for a period of time. And that's not a little bit of time. It's going to be a period of time, seeing things repeatedly thrown at you, talked about, spoken of, hinted out. It's going to go here. It's going to go there. Look for price to go here. And then seeing it unfold. That's where the learning comes from. It's not applying an indicator. It's not applying regurgitated horse shit that everyone accuses me of. Okay, everything that I teach is completely alien to what is out there in the real world, okay, of retail trading. The professional mindset that I hopefully try to cultivate in the things that I do, it largely is hinged on your ability to spend time in the price charts yourself. Okay, my model isn't, okay, now look at me. Now here's what I'm going to do. I'm going to do this, and you're going to do the same thing. And the only thing that does is teaches you, number one, dependency. And I don't want dependency. The whole thing starts from my children. I want them to be independent of me. And when I go and move on to wherever I go in the other life, or if I choose not to do anything with trading anymore, yeah, the resources that I'm making available are for them. They are able to look at this stuff. And there's a lot of things that I'm not going to make available, but it's just for them. So you're just part of a witness to the things I give to them. Okay, so I'm not trying to sell nothing. I'm not trying to put something out there. Eventually have a fund. I've been asked about that too. Am I going to eventually try to pull people's money and trade for a fee? I don't want any of that stuff. I don't want any of that. Okay, so I enjoy doing this, but I don't want it to be misrepresented by some goofballs that think they know something and they don't, and all the while they're over here trying to sell my stuff and relabeling it themselves. Okay, so ICT order blocks are completely specific levels. Okay, they're not ambiguous zones. And when I shared that link, excuse me, when I shared the link on Twitter, it's not a knock against Vic Noble, okay? Because Vic Noble's in business. He's trying to make money. He's an instructor, educator, whatever it is, okay? But the guy that he's backing now is saying that he worked for a bank and he made the software program for the bank, and I'm calling bullshit right away on that. Okay, first of all, you're not the one doing it. Okay, you aren't the one doing that. Secondly, you aren't the one, okay, showing real institutional order flow or quote unquote banking levels on an MT4 platform like that video suggests. And I'll tell you what I mean by that. When they draw a level, and this is synonymous with supply and demand as well. And again, don't take my word for this. Go and look at this stuff, okay? So when we see ideas like this is resistance. Obviously, we know that because price went up there and rejected it, okay? And that's given, no problem. You have no problem understanding it. Everyone understands that. What leads to this level becoming a resistance level before it gets there and trades there is completely and utterly independent from looking at it like we do in textbooks or educators telling us this was resistance, okay? The fallacy with educators and gurus, okay, and honestly, a lot of my subscribers fall into this group, okay? They will hear me speak, they'll hear me talk, they'll see examples of my videos, and I do a lot of lipstick and window dressing with my presentations because it's my personality. You may not like Deadpool, you may not like sniper stuff, you may not like some of the things I say, you may not like when I occasionally drop a swear word, and you're going to send me an email and tell me I shouldn't talk like that. I'm real. Okay, I'm not trying to be anything but who I really am, and I sometimes show my real personality, and I try to be as cordial and respectful as I possibly can. But sometimes it just you got to get a little real world sometimes and shake somebody by their lapels. But when you look at things and you study price action, you have to know before it becomes resistance. Otherwise, it's going to be of no use to you. Okay, you have to have an idea rather, or a mindset going into that price level that it should offer a resistance level. Otherwise, what use is it to you? You're going to be able to point at on the other side of your chart like we're doing here and saying, look, here's resistance. Well, trade it. Can you go back there and trade that? No, you can't. Okay, it's already passed. It's a missed opportunity. But supply and demand will teach you that, okay, well, there's a supply level up in here. Okay, there's a supply level and it creates a zone, and they'll draw all these boxes and rectangles, which will look by the first introduction to it like an ICT order block or an area which I highlight, okay, where we move back into a up or down candle. And that's not the same thing, okay? And believe me, we're not arguing semantics here. It's very specific. When we look at the mean threshold, okay, the middle of an up candle, the body of the up candle, that's the level at which the institutions are going to be trading at many times, okay? That's the highest point it'll go. Let me zoom in here. And let's take this off. You can hear my puppy snoring, but just deal with it. So we have this up candle in here. And what we do is we measure the body of the candle right in here, okay? Now, an up candle prior to a down price leg, okay, or swing away from a level like this is very easily discerned because we see very significant price move away from it. The up candle is where the institutions have to sell into that. And this is all rehashed. We all know this, okay? But I really want to draw a distinction between this because I still see this stuff popping up. And because it's fresh today on Twitter, I just want to rub their nose in it. The body of the candle here, okay, all this movement up, right into this move higher, that high creates the resistance level. That's the high of the price swing, okay, or the swing high. Okay, when we see that, think about it. You work for UBS, okay? You are trying to get out of a price move that you are trying to take profits on. Okay, you're a bank trader. Your job is the speculation side of things. You're not in the business transactional side of the bank. You're actually in there doing speculation. And yes, there are traders. Let me get myself comfortable here. There are traders in the bank level that speculate for pure profit. Now, it's not a large, openly discussed topic, okay? And some of them will say, well, there's really very little speculation in the banking level, and that's because they aren't privy to it, okay? That's the area I came from. That's the area, okay, or field that I came from, okay? That's the area they wanted me in, okay? And my idea was, well, if I'm learning how to do this. Why would I want to work for anyone else? I could just do this on my own. And I left with a great deal of animosity placed on me, and it still follows me today. But nonetheless, the bank has to unload that as the price is moving up. It cannot do it effectively as it's starting to move away, because they don't get the efficient exit points for their potential profits, because their size of trades are so large. Now, they're not in there leveraging 50 to 1, 100 to 1, 400 to 1. They're not doing those types of things, but their scale is very large, and they have to have counterparties to the other side of that. So because they're trading on an interbank level, they have to find counterparties of equal or greater size to eat into that move. So, and then we're not going to be talking about pancakes. So the up move in here, okay, this candle is where all the selling's done. When you look at supply and demand, they'll say, well, look at this down candle here. There was some supply here. They sold all here, okay? And they'll draw your attention to this candle or this area up in here, and they'll draw a rectangle around it. And they'll spend a whole lot of time with the upper side of the range, okay, or zone. And that's like I said in the past about Ninja Traders, quote unquote, dynamic support and resistance, which is a load of shit. That really, as soon as I hear stuff like that, as soon as I see things like that, I already know right away they have no idea what they're talking about. And I want you to do the same thing, okay? Because unless you are anticipating a turtle soup environment, okay, or false breakout type thing, okay, this idea won't hold water. It won't work, okay? It won't work. So, and I'll explain what I mean by that. So I know some of you are questioning what, can you explain that? I'm going to. Just let me get through the thought process, please. So the up candle is what we look at. Now, because they are selling into this move up, your eye needs to be trained in, okay, well, they started the price move up in here, okay? So they're selling all in this big bullish candle. So in this big bullish candle in here, the likelihood of them getting out from the middle of the range of the candle up to the close of the bulk of the body here. And let's highlight that so you can see what I'm talking about. The likelihood of price right in here. Yeah, we'll stick with orange. That's good. The likelihood of price getting back into this side of the body of the candle and up to the high is very, very slim. Now, I know what you're seeing. You're seeing the same thing I'm seeing. Well, it did it over here. Yeah, it did. There's going to be a few times where it does that. And that's where the hook comes in for supply and demand. Traders will say, well, see, this is right here. It went right back up into this zone, and there's your sell. And that's great. That's wonderful. Wonderful. One-time example. You have to you have to subscribe to the idea that that's not always going to happen. So my work was, okay, when the banks, okay, are selling into this, they're trying to get specific price levels. They're not just selling, just throwing it out there and hoping someone else, they're looking for counterparties, okay, and they're very easily discerned in the marketplace on the interbank level. They're common knowledge, actually, because the banks are out there saying, look, I need to move 200 million. I need to move, $500 million. I need to move $1 billion. I need to get this, I need to get this transacted. So when you see that on an institutional level, which you can't see it on MT4, you can't see it on market profile, you can't see all that kind of stuff. It's completely outside of the scope of what we can see on a retail level. You have to be in that environment to see it. You got to be elbows to elbows with it, okay? And that's some of the things that's a barrier for people like myself that have had the experience, have seen it, okay, and I had to bridge that understanding through what I see in price action. Is it something that can be seen repeating in a chart? Because if you can see it in a chart, the concept is conceptualized, and then you can pass it on, like I want to pass it on to my children. So what my work was, and this is all me, this is not someone else's rehashed stuff. I didn't find this somewhere else, okay, but you're seeing it all now. I'm sharing the links. When I see my stuff pop up, or if they even hint to it, I show it out there. I give it. Now, if I'm trying to copy somebody, people that copy stuff don't take you to other sources of it. they want to deny it, or they want to hide from it. I will show you other people are taking my things. Okay, they're doing that, and they're selling it. Now, my question is why don't they just trade it? Just trade it. You'll make more money. You don't have to worry about subscribers. You don't have to worry about services. You don't have to worry about any of that horse shit. Make your own money. You can write your own check. There's no reason why you can't do that. So when I see folks out there, well, I'm starting my own signal service. I'm starting my own analysis thing. Why are you even monkeying around with that? I've given you so much already. Forget Market Maker 12 for a moment. And yes, we're going to talk about that. You have so much given to you already. There's no reason why you guys aren't on the pathway to completely just leaving your job, doing what you got to do to live your own life. You have enough now. Why are you even worrying? I'm telling you, I did that stuff. $75,000 a month income. I was getting that. I don't want it. I don't miss it. I don't need that. And believe me, if you are confident to the degree where you want to teach other people, then you sure as hell better be confident to trade your own money. If you're not, there's a problem. If you're selling it, that begs the question, well, why are you selling it? That's a tiny little pissant amount of money. It's a small little insignificant grain of what's potentially available to you as a trader, understanding the stuff I teach. Why are you selling it? Seriously, you know who you are. It's a couple of you. And to get on there, okay, and sling, oh, well, this and that, dude, forget about it. Okay, if you're going to judge this on my FX book, that ain't done. It's not done. I haven't hid anything. I haven't done anything except for let everything into a drawdown. I waited and I waited. And there ain't one of you stepped out yet. Not one of you. Not one of you said, well, I'm going to show this guy. I'm still here. I haven't hid anything. I told you I was going to make an average of 3.5%. And look, it happened this week. Every single day. Do the average on it. It's done. And I'm going to do the same thing next week, and I'm going to do the same thing next week, and I'm going to do the same thing next week, and I'm promising you that my FX book's going to show $150,000 in it inside of 6 months. And here's the kicker. It's going to be $1 million before the end of the year. So kiss my ass on that one. So getting back to this. The up candle is where they sell. So my idea was, okay, well, how do I get to drawing out the selling that they're really trying to get in here? All the movement past the halfway point of that candle, this is all stops. This is all stops. There's liquidity. It's reaching up there, expanding for the liquidity. What's it reaching for? Well, look right next to it. See these two candles? This is a down candle. That down candle, folks are going to say, okay, well, it's ready to go down. So let's put our stop loss right above that level, that high. So that's the reason why it expands and snags that and takes them out. The institutions are not selling the largest portion up here. They may get another portion of it out with the liquidity offered to the left over here, but by far and large, you're going to see that it's the low of the up candle to the halfway point of the body of the candle. That's the bulk of the volume, okay? So now, while we brought up volume, I understand that the foreign exchange market is not a centralized exchange, and I think everyone else trading it knows that too. It's an electronic medium that you're trading through your independent pool of liquidity that your broker offers, okay? And I came from trading futures, so coming on Twitter to try to tell me how to do it with a monkey mask on is a little ludicrous, okay? I've made millions of dollars trading the commodity markets, and while you're scraping around looking for slings to make yourself look funny on Twitter, I've already walked you, okay? So I know more about the futures market than I've shared with the foreign exchange market. I cut my teeth on commodities, okay? And I can tell you that the foreign exchange market is by far and large well beyond the futures market. Way, way better. And if it was not the case, I'd still be trading commodities. I don't trade commodities. I have not traded commodities in a number of years, okay? I don't trade bonds anymore. I don't trade S&P 500. I don't trade ES. I don't trade gold. I don't trade silver. I don't trade any of the metals. I don't trade any agricultural markets. I don't trade the softs. I don't do any of those things anymore. I found what I love, and it's the spot market, okay? It's so liquid, and you guys just see what I talk about in the retail world, okay? I have prime brokerage accounts where I'm trading cash level because there's no leverage. I trade millions of dollars in a bank level. I don't do any leveraging. but I make so much doing that, I don't need to do anything else. And it's so liquid. I can choose whether or not I want the price that's offered to me. Can you do that with your broker? Once you're filled, that's your price. I have an option. Do I want that price or not? There's benefits to that, okay? And you got a little bit of time to do it. You can call up and call back and say, look, yeah, I don't want that quote. Try doing that in your retail world. You can't do that. And again, these are all assholes that get on here and they think they know something, and they're going to try to call somebody out. Dude, you have no idea who I am. You have no idea who I am. The only thing I've shared with you is what I'm willing to share with you. But I've shared enough to know what I teach and share makes tons and tons of money, okay? I'm not trying to teach people to be materialistic. I'm not trying to be an educator that promotes egotism, okay? And you're hearing a little bit of mine today, and I'm letting it come out. But believe me, I'm throttling back because I could really, really do a whole lot more than this. And you probably are laughing. You're probably snickering, saying, well, look at him. I got him. You don't got me. you do not got me. I'm sitting on my couch, buddy. You're at work. You're at work stealing time on your boss's internet. Okay, that's what you're doing. I'm sitting here on my recliner, okay, relaxing, talking to you schmucks. Okay, not the subscribers that I invest my time in, but the goobers that I'm referring to right now. You know exactly who you are. Okay, so when you look at my things, understand there's a distinction between supply and demand and ICT order blocks. The ICT order block is this level right here, the bottom of this orange candle, orange range in here to this. Right there is the ICT order block right in there. Okay, that's what you want to look for, and that's where the banks are trading. It's the low of the up candle prior to the down move up to the middle of the range, the mean threshold. Okay, that's the midway point. Anything above that is too thin of liquidity. It's too thin. You're not likely to get that, but you have a 90% likelihood it's going to trade into that right here between the middle of the range down to the low. Many times the trade occurs right at the low. Think about that. Okay, so in your notes, if you haven't already established this understanding, that's really where you're supposed to be at. Now the question is when you have that information, let's contrast the two things here. And what I'm doing is the equilibrium line here, that's the 50% level on the fib. I just highlighted what I view it as. I don't like fib levels at 50 like some educators use it like it's a real meaningful thing. I use it conceptually to illustrate where fair value is in like this, the mean threshold, where it's the middle of the range of a up candle for an order block. This is the area at which we highlight for an ICT order block. Okay, this is not supply, this is an ICT order block. So inside of this area, okay, what we do is we look at the highest point and the lowest point of the block. Oh, I grabbed the wrong thing. Okay, so now we have a range of 99.63 and 99.15. Now it may be a little bit off that, but right now it's going to accomplish the method nonetheless. My question is this: between 99.63 and 99.15, what institutional levels reside within that level or inside that range? Okay, because now we're going to talk in similar vernacular as it relates to supply and demand up to this point. This is where the distinction is established. There's a leap into well beyond the level of vagueness that's shared in supply and demand to now specific price levels. We're going to get very specific right now, okay? Because the banks are not out there guessing, well, I hope there's somebody out there in this zone that'll trade with me. I hope there's somebody out here in this big, vast range of opportunity, okay? They have a specific level in mind, okay? And knowing these levels okay, is a phenomenon that repeats over and over again. It doesn't change. This process is the same every single time. It doesn't make a difference what time frame you're looking at, okay? But obviously, the larger the time frame, the better, because the banks are not trading on 5-minute charts and 1-minute charts and tick charts and 15-minute charts. That's not what they're trading off of. You as a retail trader can see the order flow coming into the market on a smaller time frame, a little bit more detailed, but it's not them looking at these smaller time frames and saying, well, there's a level here on this 5-minute chart, I'm going to trade on that. All the things you see on a 5-minute chart and 15-minute chart and an hourly chart, they're all subordinate, okay, to what you see on a monthly, weekly, daily, and at the very least, the 4-hour chart. And I'm going to say 4-hour chart with tongue-in-cheek, because the majority of it's all on the daily chart, okay? So between 99.63 and 99.15, okay, when you look for it is you want to see what levels are residing inside of these two price points, okay? And we like to use round numbers, starting with the 80s, 50s, 20s, and round again. So you have a full figure, mid figure, the 80s, and the 20s, okay? So we have, without a doubt, 50 is definitely one to be considering. And because I have this little go-to webinar thing on the right-hand side, I have to do it like this. I apologize. And I just messed it up. How about that? See what I can do? All right. I'm going to stay away from that level. All right, so the institution level, or mid-figure, 99.50, okay, that's the level that you would go to immediately. That's the first one you go to, okay? And then you can fine-tune an 80. Well, we're outside of the range because we didn't get to 80, did we? The upper part of the boundary of this up candle, 80 would be up here somewhere. So we can't incorporate the 80 level, okay? The other level that would be potentially available to us for a trade setup is the 20 level. And I'll go into more detail again why we're pulling this up. I know there's a couple of you in here that have no business being in a level of education like this without having gone through all the other stuff, because I see some of you asking what's an order block. So here's the 20 level, the 99.20 institutional, and then you have the 99.50. Okay, now I'm going to take a step back. I'm not going to spend a whole lot of time with this, but I just want you to look at this for a second, and you tell me if anything jumps off the chart based on what I just showed you. Cue the Jeopardy music. Clearly, the 99.50 level, okay? Do you see how price kept the bodies right in subject to the mid figure? You see that? Now, you see a wick that goes up a little bit deeper past the mean threshold, and that's sometimes going to happen. It does it again in here, goes a little bit deeper, and sometimes that'll happen. Does it again here, and yes, sometimes that'll happen. But the bulk of the volume is always in the bodies of the candle. And look at the bodies of the candle. See that? This is the level they're trading at. They may have reached price up in here. They may have offered a smaller block of orders to spread price up. Once there's a trade at a price level, everything below it is now they're active. In other words, if there's limit orders in a range between, like, say, where this candle opened up, okay, if it trades up to here, everything from that high to this previous candle, if it was a limit order in there, it's all now become a market order. Now, based on what those orders are, whether it being buy orders or sell orders, is the basis of how the liquidity is being introduced to the marketplace. So if we understand that the backdrop is over here, that they sold it as a resistance for whatever reason, we know it's the resistance because the price moves a significant level away from it. Then it came back into it, okay? Inside the orange area is where you're looking for your trade. You're not worrying about a specific zone. You're looking for a specific level. You're looking for specific precision price points. And we're looking at a daily chart here, okay? So if I go and I look at it's not what I want to do. And that's not what I want to do either. Let's see. I knew I'd grab that thing. Mess it up. Okay. Let's leave them there so we don't mess them up. And gotta get the date on when that actually traded into it. All right, so we traded into these levels on th of April 2015. Okay, so we will drop down into, I'm not sure if it'll give me it on an hourly. Let's drop down to a 4-hour. All right, so here's that same price action. Right in here on a 4-hour chart. Okay, here's that first time it came up there and created the resistance level. Price moved away, and then it came all the way up into it. Okay, now here's where the PhD level of ICT stuff comes in. Okay, it's not enough to simply looking at the levels and breaking it down. It just draws your attention to where the trades are going to set up. Okay, and it's going to be a deviation between where you expect them to form and where they actually form at. Okay, and I think, and I've said this in the past, a 15 pip variance between what you anticipate seeing happen and where it actually forms, I think that's a realistic expectation. Okay, especially if you understand how to do a top-down analysis. What we're doing here. Okay. Now, obviously, we see price moving away. In hindsight, perfect. We understand that. We can't trade that, but we have to learn from it. We use these concepts to build our understanding, okay? And to understand there are specific price levels that we have to look for, not zones, okay? So, and again, I understand some of you are saying, well, supply and demand is an area that highlights zones, and then you look for price patterns. Okay, great. I understand that. But you're not going to see banks basing billions of dollars on animal patterns, okay? They're not looking at price action thinking, well, that looks like a zebra pattern. Well, there's a hunchback or a platypus, and there's a, there's a bluefin crab, and there's a rockfish pattern here, and look, I've been there, I've done it, okay? I know some of you can, well, you just don't know. I did it. I traded harmonic patterns, okay? Quote unquote advanced patterns. There's nothing advanced about that except for your advanced waste of time. Okay, you're attributing way too much credit to something that is really not doing anything for price. Harmonic patterns do not move price. What did I just say? What did I just say? That's blasphemous. I should have never said that. I'll say it again. Harmonic patterns do not move price. Large traders' orders move price. If you change the thought process when you view price action to understand where are those orders going to manifest, and or where do those large orders materialize? Where are they resting? Where are they going to materialize? Where can they be taken in? Where will they be introduced? It's as simple as that. It's accumulation, manipulation, and distribution. There is no supply and there is no demand, period. I'll say it like this. If this was supply up here, okay, things can change on a fundamental basis. I said that word again. Fundamental, yeah. I know there's something out there fundamentally driving the banks to do what they're doing, but I'm never going to be online to be able to figure that out, and neither will you. On a very long-term macro scale, yeah, maybe, based on interest rates and stuff like that. But honestly, just because you think you understand a fundamental premise behind it, the bank can change their mind about the fundamentals. Just because employment numbers are a big deal now, housing numbers may become a big deal later on. manufacturing numbers may become a bit, it's always like a flavor of the month, okay? And it comes in waves. Wherever the hot topic is, that's where the country's economies are going to be focused on. And they're never always collectively worrying about one thing. I'm sorry, on all of them. They're worried about one thing over the rest of them. And you're always going to have medium impact and large impact drivers that come into the marketplace with news, but you're never going to have this equal distribution of sensitivity amongst all of them. There's going to be this gravitational attention placed more on one, or maybe two, potentially two, but generally it's one. You'll find out by studying it. All the major market drivers for every currency and government out there and we trade, they are highly sensitive to one over the rest. Okay, and it, like I said, it always comes in at a fad. There's something that the countries are paying more attention to than the others amongst all the reports that come out. So when we have this expectation as a retail trader that fundamentals and supply reside up here, okay, the banks can change the whole script and say, well, you know what, something is greater on the lower end of the market, okay, and those things won't ever become a factor to get back up here and trade it, okay? And by having the understanding of institutional order flow, not supply and demand, okay, institutional order flow, you'll be able to see that fundamentally they have changed gears. So therefore, price action will show you everything you need to know. You're not trading fundamentals on a day-to-day basis. You're not day trading fundamentals, okay? You're not short-term trading fundamentals. Now, you can trade with a higher level long-term fundamental premise and only trade in that direction, and that's no problem with that. I have no argument with that. You'll never hear me say anything about that. But you're not going to convince me that you're trading on a day-by-day basis largely on fundamentals that you think are, because I can show you reports that'll show what we viewed as bullish fundamentally, and then there's 15 other guys over here saying, well, fundamentally it's bearish. So again, where do you go? Where's the pool that you're drinking from? Because it's all bullshit. It is. It all is. Because it's not a matter of what everyone thinks. It's a matter of what they're doing. I don't care what your opinion is of the marketplace, and you shouldn't give a rat's ass what my opinion is either. You don't care about what I think. I'm telling you, as the mentor in this whole show, don't care about what I think about the market. Don't care about that. You don't care about what ICT thinks about the cable, the dollar, the fiber, the Aussie, Looney. Don't care about what I think. That's the worst thing you could do as a trader, because what you're trying to do is you're trying to read my mind, and you're not going to. Trust me, it changes all the time. It's changed 15 times. It's just in the presentation on this video alone. I came in wanting to talk about something. I'm already on 15 different topics, unfinished. So looking at the, when we look at fundamentals like that or levels like this implying supply up here, because the banks are the drivers, okay, because they're the big boys, okay, the retail world's not moving price. You're trading inside of a little sandbox of liquidity. The banks don't even see you. They don't see you. You're inside this little tiny little FXCM Oanda forum, okay, of tiny little itty bitty liquidity. Banks can't see that. They don't see that, but they know that everybody does the same thing. Place to stop above the old high. Place to stop below the old low. That's what that's what everyone's taught. Okay, it's the same thing. Okay, you want to know how accidents happen? They cross the yellow line and they drive too fast. It doesn't take a rocket scientist to to come to a conclusion. That's how 90% of the accidents and fatalities occur when you're driving an automobile. There's other things, factors like drinking and driving and falling asleep at the wheel, but there's small little, not trying to minimize, because I've had deaths in my family with drunk and drive, but you know what I'm saying. I mean, there's other caveats that lead to accidents. Well, there's other caveats that leads to profitability and unprofitability in trading. But by far and large, okay, it's the fact that they have a stop loss available, which is begging for liquidity to be absorbed. That's a stop loss. When you look at a stop loss, and tell me if I'm wrong, put a 1 if you agree and 2 if you don't in the room, if you're watching live right now. Obviously, if you're watching recording, you can't. But if you have used a stop loss in the past, do you view that stop loss as protection, or do you view that stop loss as a bullseye? 1, if you view it as protection. 2 is a bullseye. Exactly, exactly. So if I would have asked this question back in 2010, all of you would say it's your protection, it's your shield, okay? And I will agree, that is the only protection you have. That's the only protection you have. You cannot protect yourself any other way except for collapse the trade and remove yourself from the risk entirely. But the only shield you have in this business is the stop loss. That's it. There's no other defense mechanism out there except for what's between your ears. But that's only useful when you put it into operation. You can look at the chart and see it's going to get ready to take your stop out. You can see that. But you probably have been in this so many times where you see it happening, you refuse to take the trade off and you take the full stop. The market will take your full stop because you know you're looking at it and you say, okay, well, it's not going to get there. It's not going to get there. I hope it doesn't get there. But if it does, at least I'm protected. But, you know, then what's happening is your mind has a paradigm shift, and then now it becomes what? It's not a shield. It's a bullseye. Well, banks don't trade with stop loss orders. And that's probably surprising to a lot of you, but they don't. They don't need to. Their pockets are very, very deep. Okay, so when traders and fund managers, okay, are speculating and they put a stop loss order in there, that is the very thing that you're looking for when I jokingly say when you're a new trader or you're a novice trader or a newbie and you sit down at the price action that you're studying, okay, and you're hoping to find a trade. You're looking for a neon sign saying, here I am, okay? The only neon sign that exists is stops. That's it. Stop loss orders. And I'll give you a heads up. That's largely what Market Maker 12 is all about. Identifying that, getting right to that, because that's what the banks do. Now, because they see the literal orders in the marketplace, they see the open interest that's available at those levels, okay? It's a different animal. Like we can see where they most likely will reside above or below an old high or low, okay? But they may not be there by the time price trades. And that's what I'm about to explain here. If you believe or subscribe to the idea that this is a supply level, okay, and let's go back and highlight that, and I'll contrast it again when we get to it. If you're viewing this whole thing up here from the high in the middle part of the range, okay, or really let's do it like this, because this is what they would teach. This is a supply level up here, or zone, okay, and price trades back up into that. They will teach that there is a reason to believe it's going to go up to here when it's no reason to expect that at all. It's the least likely occurrence to happen unless it's a turtle soup environment, okay? And because that topic is so vast and the parameters that go along with looking for turtle soup versus staying under a low, and I know a lot of you ask that a lot, okay, and that's really Market Maker 12. And the reason why I took a lot of things out of 12 and redoing it. Okay, there's 12 main things inside of Market Maker 12, and I got 2 of them done. Two specific of a collection of points that I went, in my opinion, going back over looking at it, I brushed over it way too quickly, and I was a lot more vulgar in the video than I probably should have been. I kind of like warned some of you in the last video it was going to be very offensive because I was going after a lot of folks that have taken my stuff and sold it, Steve Morrow, and really went after them. So I kind of like pulled myself back and said, okay, well, I'm going to deliver this in a little bit more professional way. That way, at least I can close this circus in a better light than I would have if I would have did it that way. Because I was kind of like kicking them in the balls, and anyone watching that video would have been like, wow, it would have been totally shocking. But I think that I'm doing it better by doing it this way. And that way, it's a little bit more modular. So underneath the link of Market Maker 12, you're actually going to see 12 subordinate hyperlinks. Okay, so it won't be Market Maker 12. Click on it, and there it is. It's going to be Market Maker 12 as a header, and then there's going to be 12 individual links inside of that. So it kind of like breaks it down. I don't know how long it's going to take me to go into it because, like I said, I only got a couple of them done. So, and no, I'm not going to give them to you until they're all done. So deal with it. And I don't know how long it's going to be. So there you go. The idea of this level being up here, being a supply level, and fundamentals up there driving it lower, the fundamentals can change by the time it gets to this point here, and it never gets up to that level. Okay, or it could trade up in there and cause really no selling. It could just continue blowing right on through it. Okay, so again, it's not, you're not getting to the end of the game with fundamentals. Okay, and there's a lot of folks that are just looking at a lot of online marketing that's going on. Jared Davis is ran with Chris Laurie's work, and that's really where he got his stuff from. He's full of shit telling you anything otherwise. The guy's not self-taught. He's Forex mentor. Okay, he's Vic Noble's student, and he did something with some guy named Andrew Jenkin. It was a failed operation there too. I bought a couple of his courses, and all it was pivots and Fibonacci, and absolutely nothing. Market flow, which it's all Vic Noble stuff. Okay, and again, I'm not trying to smack Vic Noble around, but Jared Davis has got this big online campaign right now that he's the second top rated trader rated by Barclays, and then Barclays stomped him in his face and said, don't you use us, attributing us to your work or whatever. But look, if you want to learn fundamentals the right way and a whole lot cheaper, and I believe what is being shared is effective, go to chrislaurie.com, okay, or go to protradersclub.com, okay, or just email Chris Laurie or tweet him, okay, and just say, hey, look, ICT said that you have a course on fundamentals, okay, and buy it. I think it's like $99. It's not even that much money. But I have openly said this in the past. I don't get anything for it, but I think he did an excellent job explaining fundamentals as it relates to trading, especially currencies, and it's useful. It's really how he was able to call in advance. He's the only other one out there, aside from myself, that has called Canadian dollar higher long term. I did videos and showed you by levels, but he goes into great detail, and I'm not part of his Pro Traders Club to hear his discussions as to all the other things going behind it. But I know that oil was going to be a large contributor to it, and it was going to be and you know all that because of my conspiracy rants that I had 2 years ago and last year. But the fundamentals, if you're going to do that, save yourself thousands of dollars in wasted time, okay, and just simply go to Chris Laurie, and he'll teach you everything that I personally believe. If you want a sponsor, okay, if you want like a advertisement for something to spend money on, that's the one you buy. Okay, I think he did an excellent job. Again, it's Chris Laurie. You go and just simply get it and study it. You're not going to get it all one time watching it. I certainly couldn't do it. And I believe it was well presented, and it's good. So there you go. So you're welcome, Chris. Looking at the idea behind it, though, fundamentals, relating on a day trade, short-term basis. Again, I don't believe it has any merit unless you're trading with the long-term fundamental basis. Okay, with bullish or bearish, and you're only trading in that direction. Then yeah, but if you think you're going to swing back and forth on fundamentals, you're kidding yourself. You're certainly not going to sell that idea to me and believe it. So the idea is, when we look at these areas, okay, and now I'm highlighting what I believe is the, hang on, I got to disturb my puppy because she's now snoring way too loud. Bella, you're too loud, girl. So again, these are all the things you don't get to hear in my pre-recorded stuff. So there's a lot of editing, the rough cut. So this move above the ICT order block in here, okay, we reduced it down to 2 specific price levels based on the daily chart. And this is what you do. This is how you incorporate all the things that I teach over the last 5+ years. Okay, the brass tacks is this: identify where there's a likely resistance in price, okay, or where selling should come in, and where the banks are going to be trading at, and how they're going to be trading, what they're going to be selling, because they sold it here, and where specifically should we be aiming to sell short? Well, we label 99.20 institutional level inside of the range that's discerned by the daily order block, because remember, we dropped down into a 4-hour time frame right now. So this range is highlighting the levels we look for inside that range. We're not trading this for zone's sake. Okay, we're looking for specific levels. What levels? Institutional order levels. 50s, 20s, 80s, and full figures, 00 levels. Okay, the reason why we like those levels is because the banks trade with those levels. They're not throwing out, well, I'm going to trade at 99.17, and let me get a sell in at 99.23. That's not what they do. They put their orders in round numbers or in increments of 5. Okay, largely it's on even numbers, but some banks will put their orders in on 5. Bottom line is that's what you're going to see in the charts if you study it. Don't take my word for it. So we know that 99.50 and 99.20, and let's change these little things here just to highlight that being the case. Okay, so we have these two levels here that we would automatically go into the marketplace looking for. Okay, now again, just so we're on the same topic and same page of this topic here, as price trades up into these levels here, that's when you'd be doing this. Obviously, you can't do it in hindsight, but in hindsight, this is how you learn. Looking at it like this, let's zoom in a little bit more. So we have two price levels at which we would start hawking setups. Now, we went down from a daily chart to a 4-hour chart. So the next question is, okay, when price starts to trade off, because the 4-hour chart is going to give you a whole lot of advance notice. And I know a lot of you guys want to have that and need it, okay? And it's, you know, in my opinion, it's something I should continuously advise you to do, is trade on these higher time frames, because it gives you the buffer that you need. Because if you're trying to trade on the 5-minute chart and 15-minute chart, and sometimes really even the hourly chart, wow, Bella, good grief, girl, come here, come on, hey, you're sawing logs there, girl, wake up. So when you see price turning like it does up here, okay, and starts to break down, which is what you see here, okay, when you see that, the next logical thing you would do is, okay, well, what's the candle that it moved up from? Where's the low on it, and where is the body of that candle? Same thing we just did on the daily chart, okay, is what we're going to do here. It's the same premise. All we're doing is top-down analysis, breaking it down, and looking at the institutional order flow from the daily chart down to the 4-hour chart, okay? And again, institutional order flow, for those that wear monkey masks, the idea is seen through price action, okay? And yes, I'm completely aware that this MT4 platform from Forex Ltd, okay, has zero connection to the interbank levels that are available on the dollar. I know that. There's going to be a disparity. I've said this on record before, but because you're going to be hit and miss, and when you listen to me, you don't have the full story. But everyone knows in my work that I say that there's going to be a disparity between what the interbank pricing is on a particular currency versus what your platform is going to offer. And they're allowed to do that by law, okay, and your agreement. There's going to be a disparity, okay, and it's well beyond the spread that they offer too. And that's just all part of it, guys. I mean, you can't escape that. You all signed on for that risk. But when you see price starting to move away, okay, starting to come down, you start looking at levels that could potentially be new bearish order blocks, which is what this orange area is highlighted on the daily chart. It's the daily bearish order block, ICT order block, not supply zone, ICT order block. Now, since we have highlighted two specific price levels, okay, the next thing we would be doing is looking for it on a smaller time frame, on the 4-hour chart. Was there any indication that start the breakdown? Okay, once price trades up to these levels in here, you got to be aware that these may be new, smaller, short-term bearish order blocks that could be utilized for trades. Price starts to trade up and starts to break down. The up candle prior to this drop down in this 4-hour candle, you use the low to the body of the candle. Okay, now again, I'm going to use this opportunity because I get folks asking, and they're doing it now in the room. How do I know when to use the bottom of the candle or the wicks and the bodies of the candle? Okay, and in your notebook, I need you to write this, underline it, and highlight it. Okay, the big candles. Okay, and when I say big candles, think about what we talked about back in 2010 on the Baby Pips days. Okay, what I learned from Larry Williams was the markets trade in a rhythm. It's small ranges and big ranges, small ranges and big ranges. Okay, a candle like this, I would use the middle to the low, not so much the body of the candle here and the low. The reason why, because there's a whole lot more volume in here. Remember, the body of the candle is where the majority of the volume is for the buying and selling. Okay, so when there's a smaller candle, I like to use the wick to the body of the candle for bearish order blocks. Okay, and we're going to highlight that here. We have a small little body candle. Now, I'm not going to use the 50% basis of that candle. I'm going to elect to use the low to the body. And I know some of you pundits are already saying, well, yeah, because you can clearly see over here. Again, this is the reason why I'm telling you this, because I want you to go into your charts and you'll see this phenomenon taking place. Big candles, big body candles, okay, you're going to use the 50% of that body of the candle, or the mean threshold. Okay, that middle point is about half of, well, it is a half, but it's the bulk of where all the institutional order flow is going to come in, and it'll be self-explanatory as I go. Looking at the up candle here, using the body down to the low, there's your institutional order block, bearish, not supply zone. Okay, supply, they'd have all kinds of business up here highlighting. We don't do that. Okay, so inside of the range created here, okay, let's just borrow these. There's that. I knew I'd do that. Okay, and I'm just going to put it on this side over here. It's the same thing. So we have 99.72, and the bottom of it over here, 99.64. So my question is what institutional level or levels exist between those two price points? Now, yes, it's a smaller little range, but nonetheless, the process is still the same. We have 99.70, round number. Wait a minute, Michael, you didn't say 70 earlier. Yeah, I know. Institutional levels are 00, 80s, 50s, 20s, and back to 00. Smaller round numbers, okay, can be utilized in between those other levels if there is a premise or reason to use them, which is what we framed out here. We already anticipated selling inside this range here. Price came up a little bit, stabbed through it. We allow for that. Then starts to come back down. Price comes back up into it. We can look to be a seller again. It's not going to, based on what we identify as a bearish order block, it's not going to go to 99.80 institutional. It's likely not to do that. Let's just rephrase that. Based on the fact that 80 would be up here on the other side of the body of the candle, which is not what we look for. Okay, supply would say, look, up here, there's some supply up here. There's some supply in this down candle. Okay, so it could go up as high as this candle here. No, it won't. Why would you expect that? Not on a consistent basis. It's not going to do that. Now, you're going to send me 20 times it did it, but I can send you thousands where it didn't. So inside here, we have 99.70 and we have 99.65. Remember, they like to use 5 rounded to the 5 numbers, okay? Now, I know some of you also are thinking, well, it's what is it? It's going to be 70, it could be 65, it could be, you know, this, that, and other thing. You're only going to use the levels inside of the range, okay? This is the range that's identified for the ICT bearish order block, okay? So now, what we just did was refined it down to 99.70, you're going to sell at, or 99.65, the round number. It doesn't get, you can do 60, you can do 60 because it's below the market, okay, and it's still very close to here. There's nothing wrong with that either, okay, but if you want to be specific and follow the rules as I teach my children, you would be trading at 99.65 or 99.70, or if you want to get fancy dance and try to do like I do, I want to make sure I try to get in the move. I'm not trying to worry about 10 pips. I want to get in the trade. As many times I don't get a trade because I insist on getting the very, very best fill. And I've done that, well, 8 years ago, I was really insisting on that, and I missed a huge amount of spectacular entries that I just really pissed away by being too demanding on price action, and I just missed them. And some of you seen it last year in some of my trades when I did live sessions where I just missed it by a pip or two, and some of them on exits. Okay, so anyway, looking at that, let's leave those levels there. I don't want to do that because we're going to refine it even more. Okay, so we have price trading in at 99.70. Okay, and it takes you right in here. Now the high on these come in at 99.71. Good grief. And 65, we'll look at that. Okay, and clearly you would have no problem getting in that in here. Okay, and price starts to trade off and does another explosive move going down. If you are remembering that you have the 99.20 and 99.50 mid-figure and institutional 20s on your chart, okay, price breaks down and then does what? Comes right back up to it and gives you the entry right in here, right at a level you've already identified. Inside of a bearish order block on a daily chart, it's been refined. You have all the conviction now that you need because you see institutional order flow is respecting where they should sell, they are selling. And then we have a big range, liquidity void in here. Price comes back, boom, right at a level you already anticipate, 99.20. 99.20 is based on a daily chart where banks are referring to. This is not a 5-minute setup. It's not a 15-minute setup. It's not even an hourly setup. This 20 level was already based on the range that was created on the daily ICT order block, and we refined it down to what two levels are essentially what you should be trading at, the 99.50 and the 99.20. Okay, so let's go down further into an hourly chart. Yeah, it won't give me. It's too far back. I can't go down that small. Well, we'll have to stick with the 4 hour. I went back a little too far for that. Too ambitious of a study. So let's zoom in. Okay, and we have several things in here that are indicative of what you would expect to see in price. So when we see price action turning like it is here, okay, you can see price action on a market structure model where you have a swing high, a higher swing high, a lower swing high, and in between that, think like head and shoulders type formation. Okay, it breaks down, it comes down. I'm not looking at this retest back to a neckline type thing because if you look at it, it doesn't even do that. It doesn't retest the neckline if you're looking at head and shoulders. But I'm looking at it in such a way where it shows a breakdown in market structure. It does, in fact, do that. If you look at what goes on also, the ultimate high here, okay, The question I like to do is when I'm looking at price action, let's take this off because we don't need that one anymore. Zoom in. These are some of the things that I have as an internal dialogue when I look at price action, either real time or if I'm looking at things in hindsight, trying to frame an idea on a future move or kind of like forecast. When I see things like that, like this high in here, okay, my question is always this. Okay, it could have turned on this high and it could have dropped right from there, but it didn't do that. It ran up one more time and then dropped off. So when I see that inside of an area when I'm anticipating a sell-off, okay, I view that as it came back and took out early bear stops. And they're going to have buy stops right above this high because they're trying to sell it short. And when they see these two down candles, they get in there and thinking, okay, I'm going to try to catch the high. And that's why I do not trade like that. Looking for the liquidity that's resting above the high in here in the form of a stop, buy stops on shorts. Okay, they rally them up, take those people out of the marketplace to take the other side of the trade. Those buy stops become orders to buy at the market, which is exactly what they want to use as a counterparty to get short. They're going to sell those buy stops to them. That's the position they hold for a move lower. When price starts to trade back down and makes this little bit of an attempt, it trades up into a bearish order block and sells off, your thought process should be immediately, okay, if they're selling back here and we're in a daily setup inside this ICT order block, a daily setup can see it retrade back into it, and a 4 hour too. I don't like to see it do it more than once, but in this area, we're in that daily order block right in here, okay? Look closely. This candle right here is the breaker that they bought that takes the rally up above this high. It's the down candle prior to the swing taking out an old high. This turtle soup setup, the foundation to it is in this down candle right here, okay? And by incorporating the bottom of that candle, okay, let's show the low, if I can get it to highlight. The low comes in at 99.32, 99.32. When price creates this big liquidity void, okay, don't assume that it's got to go back to this candle here. Don't assume that. You have to look at what has happened. And this is all things that supply and demand does not teach you. Okay, supply and demand says you can't cut through candles. You can't look past through whatever this is. This is it. This is a fresh level or it's a fresh zone, and they're going to look to try to sell up in here, and they're going to miss the boat. They're going to miss the trade. Banks aren't looking at this saying, well, this is where the fresh level is. They're going to see that the orders that were used to buy the market up here and drive price up, okay? And I know some of you think, oh, you're conspiracy theory. Take a field trip, okay? Take a field trip out to Chicago Board of Trade. Take a field trip out to the Wall Street, and talk to specialists. Talk to people that are actually doing it, okay? And they'll tell you that there are drives on liquidity in the marketplace. They'll run the highs, they'll run the lows, because when it happens, it creates all this fever. There's all this excitement. There's all this induction of liquidity in the marketplace, and because of that, that's where trades form. And they love to do that because markets are just they're only out there to take liquidity. That's what you're in here to do. You're trading liquidity. You're not trading price. You're trading liquidity. Just because you want a price level, you're not getting that price. I don't want, I'm sorry, I may want a specific price level on cable or fiber. Just because I want it doesn't mean anything. I got to take the trade and agree on taking the trade based on the parameters that's being set up in the market. Either the market price is offering something that I'm able to live with in terms of where it is and where I'm willing to get in a trade, or I pass on the situation and take no trade at all. You have to look at price action with that mindset, okay? Retail platforms are going to be very, very close, but not to the pip of what the interbank levels are, okay? The overall market direction is going to be similar, okay? There's going to be a disparity between what the interbank pricing engines are and what your individual platforms are showing, and you're going to have to accept that. There's no way around it. You can argue about it. We can all agree it's crap, but they have to have a model that allows them to be profitable. Whether it be savory or not, that's something for another day to argue about. But bottom line is, this is your opportunity to trade. You have to use a retail broker until you get more money so you can trade prime brokerage. This is how you do it. But you have to look at why, when this price runs up and then it starts to break down, go back to this. You have to cut through some candles. You got to. And it'll give you the basis of why things should take place going forward. This run up, the down candle, which is a ICT bullish order block, okay, in primarily bullish conditions, if price came back down to that area, we could be buying expecting higher prices. But notice what's happening. This is occurring in a daily bearish order block inside that orange range. So this is actually inside of that bearish order block, and it drove price up. Do not look at that as a new buying opportunity. Some buying took place in here, okay, and maybe there's some out there that try to use supply and demand, and they looked at this as a continuation. Maybe they looked at this as support. Maybe they just looked at, I don't know what they looked at, okay, and that's not what I view price like. My perspective and my thought process is, if they ran it up here and then it broke down, this was a stop run. So where did they buy the run to stops? The down candle prior to the up move. There's your breaker. So when you have that, note the low of the candle, okay, and limit it to the body of the candle, not the high. Can it do that? Yes, but your trade is going to be in the body of the candle. So what am I saying? I'm saying that if you take this range, the body of the candle to the body of the candle, okay, so the open and close, extend that out. It does not get to the bottom of this up candle prior to the down move, because it doesn't have to. All the orders that need to be mitigated, that they use to go long to drive price up, those longs have to be taken and canceled. They got to be collapsed. But they're not going to collapse them down here. When price gets back up to it, they're going to collapse them right here. So they are mitigating the open long positions that have been utilized to drive price up. They'll liquidate them here. Then liquidating and new accumulation for shorts is why there's only a short little period of time where it trades there and then it runs away, because you're having two factors being introduced at the same time. You're selling longs that were established here. You're selling those longs, which is going to be an absence of buying, okay, and an increased effect of selling, which is the natural order of things in the marketplace. It's always a seller's market, always a seller's market. So when you have that absence of buying and you have a large introduction of new selling, why are they going to sell more? Because they collapse their longs because they don't believe fundamentally that there's going to go higher. So they come back into this liquidity void, and this void, which would be essentially closed here, is not necessary to be traded up to. You only got to go back to the breaker. So that's how you use the breaker in combination with liquidity voids. There are some times where it can come back up in there and trade that, and that may be detrimental for your trade, or it may be another opportunity to get a better price entry. It depends on how much range is there and what you're able to assume on the trade. Now you can trade the 4-hour setup like this and create a whole lot of pips in terms of the stop loss that's needed, but guess what? The risk to reward is still the same. It just takes a whole lot more time for the trades to pan out. And don't disparage the whole idea of trading on a 4-hour time frame, because if you can't be in front of the charts on an intraday basis, you can trade these setups every single month. There's something out there, and there's a lot of pips to be made like that. But you got to keep things relative to the risk. So again, going back to this this low right in here on this candle, the low comes in at 99.32. So just like we used for the order block, okay, my question is okay, if the low on that candle is 99.32 and the high is 99.50, okay, and the open is 99.41, the body is the open and the close. So 99.41 and 99.32 is your range. My question is what's the price level you would use to go short using the breaker? 99.35. That's your midway point, okay, inside the body at rounded to 5. You can go with 30 and be early. There's nothing wrong with that because we're only talking about 40, was it 41? Yeah, 41 was the high of the body of this candle. So if you're okay with that and measuring your risk, okay, you can get short at 99.30, which is the round number, going into that candle because you already have the expectation that this is going to be a breaker because of all the backdrop, the daily bearish order block, the fact that we ran this high right here and it's now broken down. It's giving you all indications that it's going lower. Did you miss the opportunity to get short up here? Yes. Did you miss the opportunity to get short here? Possibly. But this one right here, you're trading at 99.20 based on the daily setup, or you're fine-tuning it using the 4-hour chart for a breaker at 99.35 or 99.40 or 99.30, okay? Based on where your risk is, there's your levels. That's how you as the trader do it. You see the difference about teaching it like this versus this is how you do it every single time. Because what I'm willing to assume on the risk is not the same thing that you're going to be willing to assume in risk. And your proficiency in trading price isn't going to be the same level that I have. Okay, so I may be able to trade with a 10 pip stop. I don't do that, but I may be able to do that. You may not be able to. And you may look at what I'm framing as a trade and say, well, I don't know about that. And then you'll argue. If it makes money, you'll say, I wish I would have did it. Or if you take it and it doesn't make money and it gets stopped out, I knew I shouldn't have done that. It's too small of a stop loss. I never do that. You see what happens? It plagues your thinking versus your development. Your choices on trade selection are going to ultimately be yours. They're never, ever, ever going to be mine or the guy you talk to online or your mentor. If they are, you're doing it wrong because it's not your trade now, is it? You're piggybacking. And I know some of you, well, if it's making money, I really don't care. I don't care. It could be somebody else's trade. I guarantee you, if you have that thought process, you will not be doing this long. You're going to lose money. You're going to lose your account. You're not going to be trading. And that's real world stuff right there. You can't get any more real talk than that. But by looking at things like this, okay, let's look at another opportunity of using breaker. Because the last couple times we had live sessions, you guys were really heavily beating on me about, well, there's the breaker here and the breaker there. So let's take a look at one more. And then I'm going to close this portion of the topic. What did I want to do here? Oh, let's take everything off. I got to make sure I remember to talk about the cable trade because I prompted you guys. I'm doing this stuff now because my wife told me that I will not be doing any videos tonight. So I'm doing it now. So I'm trying to answer everything so I don't have to do a video later on tonight. We have an old high back here. Okay, and let's go out a little bit one more time. Okay, we have an old high here. And I want you to think about as price was trading in here. Price made this high and sold off and then resumed going higher. Okay, and my question is what was the primary trend even right here? And when it was trading down, what was the primary trend? Well, on the daily chart, it's been going up. Well, not like that, I'm going to show it, but it's been going up, see? Higher, 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 higher. So institutional order flow is primarily long, okay? So price comes down, moves back into an area of old order flow, and starts to rally up. Right here, let me zoom in. Yeah, right there. Right here, price made a down candle right below an old high. I love that. I absolutely love seeing that setup. Okay, it's very similar to when we talk about optimal or high odds bearish order blocks. Okay, where there is usually a high, okay, a short-term high right below an ICT bearish order block. That's like it's like a no-brainer setup. It's so very, very powerful. Well, along the same vein, this is what is very similar to that. When we have an old high like this, okay, and prices traded up and then it's starting to sell off, okay, what you're seeing is weak bulls that think that this is going to be resistance. So they sell it. And dare I say it, potentially maybe there should be some supply up there. Maybe there's some supply traders up there trying to sell it, because look what it did. There's supply there and it's sold off. So we're back up to that level again. We're going to sell it again. There's some supply. Okay. I love this setup because what this is they're introducing a setup that allows folks to do that very thing. And as the market's dropping down, do professional traders sell or do they buy in those environments? Down candles, okay, it's the 4-hour chart, so it's a lot of range. This down candle right here at the far right of the chart, I know I don't have a highlighted on my cursor. I don't have the opportunity to do that with live sessions like this. But the down candle, okay, on this 4-hour chart, that down candle, just because it's the 4-hour doesn't make a difference, but we understand that the largest players in the industry, which is the banks, okay, they're going to buy in down moves. They're going to be buying as the market moves lower. They have to do that to get a better average price, getting into the trade. When I see setups like this happen, it's wonderful opportunity to set up. Number one, confirmation that we're going to blow through this. Okay. Secondly, it sets up future opportunities because there's a whole lot of buying and selling interest on a level like this, because it's inside of an old high, inside of a range, and it's down. So now think about what's going to happen here. There's going to be a lot of buying in here. When it blows through it like this, okay, watch what happens as price goes on. Price comes back down, okay, and then look what happens. Look at the reaction rate in here. This reaction right here, trading right back up into what we just described earlier, is the breaker. Let me highlight that and put that back on here. When I tell you guys look at the daily and the 4-hour chart, I'm not telling you that and wasting my breath doing it. I want you to do it because every major setup that you'll see in price is going to be found on the daily and the 4-hour. That's a given. You want sizable, explosive price moves? Everybody does. But you're never going to find them outside of those two time frames. I mean, you can obviously find them on a weekly and a monthly chart. That goes without saying. But the dynamic price levels that you're going to trade off of, that you get this real big explosive boom. I mean, you just explode. You don't have any time wasted. It gets to those levels, and then it tears and goes the other direction to another level. That makes perfect sense. What do I mean by that? Well, we explained how price reversed up here on a daily bearish ICT order block. Then price makes a move lower. We marked off our breaker, and this is where price would reach to. Not here. Could it have? Sure, it could have. But it didn't. And it didn't have to, because the buy orders that we used to run the stops on this old high, that's the reason why. Now, by itself, right there, that argument right there, this one presentation just kicks supply and demand right in the nuts. You can and you must cut through candles. You have to look at the context of what price action is telling you. But because supply and demand doesn't teach you or even imply an interest in showing you how the institutions are trading, they're just giving you one little tiny little facet of, okay, it moves from here, so if it goes back there, it probably will happen again. There's no difference between that and Fibonacci trading. And I just nailed it right there. Supply and demand, put a fib on your trades, and it's the same thing. Trade 79% retracement levels and 62% retracement levels, and you're going to get the same thing supply and demand gives you. Done. It's handled. So it's a gimmick, but it gets you very close on some instances, but it really won't do anything except for take credit. It won't be able to explain anything outside of, see, we were right. My work gives you the X-ray view of why price is doing it. Okay, and by studying hindsight examples of seeing it happen on larger time frames like the daily and the 4-hour, it will give you the context to frame your future trades, or at least give you the framework to start trading ideas and practice them. Because until you start thinking like this, and like we're about to explain here, you're not going to get it. What is it? consistently profitable, because you're going to have hit and miss types of trading instead of surgical strikes, precision, in and out, knowing why you're doing it, when to do it, when not to do it. That's what you need to know as a trader, not reacting and wishing and regretting and just being just totally upset because you don't know what you're doing. And it's frustrating. Believe me, I know what that felt like, okay? But you were expecting a magic bullet, and you're not going to get the magic bullet to give you the insight like that. It's going to have to go through a process of doing what I'm doing here. And that's why the assholes that watch and troll, they don't like it, because they want an easy fix. They want an indicator. They want something to plug on a chart and show it to them. This is the indicator: the open, the high, the low, and the close, and the reactions that it creates on your chart. And you're studying the psychology in the marketplace. That's what price action's doing. It's measuring the psychological effects of what other traders, and the only trader group that we care about is the institutional traders. They're the ones that move price, because our mindset is focused on what they're doing and how they react. Well, they're the predator. They're the apex predator on the food chain. So if you align your thinking like they do, and they view stops as opportunity, they're bullseyes, not protections and shields. Believe me, the banks are driving bulldozers, and you're standing there with a little pinwheel. That's your stop. They're mowing you over. They're not worried about what's going to be the ramifications of you getting stopped out. You're just one more piece of meat going in the grinder. There's no reason for you to view your stop loss in any other way except for, yes, it's your only protection and shield, but it is a bullseye in the form of the institutional mindset. Sobering, isn't it? Bet you didn't think you'd hear those types of things when you first got started in trading. You thought it was a free opportunity to be, everything's fair. We all want to see you make money. It's bullshit. They want your money. They want you to fail, okay? And they want you to blame your indicators. They do. They want you to blame it, because what that does, it feeds the fire for someone else's new book, a new system, and new stuff. And it brings in, like P.T. Barnum said, there's a sucker born every second. Done. Well, it's your choice if you want to stay in that sucker realm. Do you want to listen to assholes on Twitter telling you that the stuff you're learning doesn't work? Or do you want to put the time in and see that it does? And don't expect it to happen overnight. I told every one of you 6 months of in the trenches dealing with this stuff on a daily basis. Now, I know some of you are going to say, well, Michael, I've been following you since 2010. It isn't clicking. And you should have told me this stuff from the beginning. No, I shouldn't have. No, I shouldn't have. And I'm going to tell you a reason why I shouldn't have. And if you can't get this or understand it or agree with it, that's between you and your problem with it, okay? Because I can't fix it for you. You have to go through the process of seeing why retail traders think like they do. Not just simply reading in a book and say, okay, yeah, I get it. No, you don't get it. You don't get it, okay? You do not get it until you see it in price action. When these yahoos get on there and they say, hey, look, this guy's talking about this and that, believe me, you're going to laugh your ass off too, because they're clueless twits. They have no idea what they're doing. They're out there chasing the next best thing. And guess what? For a little while, I was like that for them. I was the next best thing, because I could show something that made a little bit of sense. Oh, yeah, order blocks. Oh, yeah, optimal trade entries. Oh, yeah, they ran on TradingView. Oh, I'm glad you showed up, ICT. I've been using the OTE for months, and it's just been phenomenal. It's not all OTE. It's not all order blocks. It's how you look at the marketplace and you judge based on what the chart is showing you. Where has it shown a willingness to sell off? Why would it have sold off there? These are all thought processes that you have to go through, okay? So there's a dialogue that you must have with yourself as a trader. It's self-talk. We all have it in all varying degrees as a trader. We all have self-talk. Self-talk in the beginning as a noob is, man, I have no idea what the hell I'm doing. I need to find somebody that knows what they're doing and just copy them. That's self-talk. Is that empowering, or is that self-defeating? Self-defeating. You're staying with a mindset that is dependent and not independent, okay, or empowering at all. You're subscribing to the thought process that number one, A, you're weak, you're clueless, okay, and that you need to have someone else tell you what to do. Now, that's the reality of it, yes, but if you don't change the way you think, you're not going to look at the marketplace the right way, because you're going to look at, and I'm going to take one more step further in this. Think about when you first started as a retail trader. You started thinking, okay, where's the next guy in the line of all of us, okay, that knows what he's doing, is making money? Because you don't know how to talk to a bank trader. You didn't even believe the bank traders do this. Think about it. And in honesty, you didn't know that. You wanted to find someone on the internet, someone on Twitter, someone on Instagram, someone on Facebook, someone on an infomercial, someone advertising something, a direct mailing, okay, telling you that they're doing it. And maybe you thought it was horseshit. Maybe you thought it was all smoke and mirrors. But the advertisement, or the fact that they ran their mouth as much as they did, and you've probably seen that happen with me. Man, this guy, it wouldn't leave you alone. It starts gnawing at you, and you have to just dig into it and see what it is. And it doesn't pan out. Why? Why doesn't it pan out? Because you have not taken it as your own. You have not changed this whole perspective on trading and made it your own. Now, I'm not saying take my stuff and take someone else's stuff and remarket it and sell it. That's not what I mean by make it your own. Okay, what I mean by make it your own is internalize it, break it down into minute details where you understand each component, and then begin to flesh each component together, and then your trading model will materialize from that. I've given you so many tools, and I'm tickled when I see so many people come at me in an email, or they do direct messages on Twitter, which I really don't like doing those things because I get so many of them. I have a lot of them on there, and I haven't even opened up yet. So if you sent me those by Twitter, just know that I don't like to do those, and I'm not trying to be ignorant to you. I'm not trying to just ignore you. I'm trying to ignore everyone because there's too many of them. So looking at price action, you need to adopt the mindset of, okay, my trading is my trading, okay, and everything that I do in my trading is going to be my responsibility. So the fruits of it, or the bad events that take place, I have to own that, and I have to take ownership of the good and the bad. And the bad, I have to be sober-minded and learn from it. I can't be a victim and say, well, you did this to me, or you held this back from me. I held back stuff, yeah, for your better, for your embetterment. You didn't have the capacity to look at this stuff like you did, because you didn't have the time looking at price action the way I look at price action. You have to be able to discern the distinction between how retail-minded traders, and even back then in baby pips, a lot of you didn't even think like a retail trader does. You didn't know anything. You were just looking for the next thing. There were retail traders out there that were hanging and banging, still unprofitable, but they had a method of what they were trying to make work. But they're trying to force a square peg into a round hole. It won't work. You got to cut some corners off. Okay, you got to smooth out those rough edges, and that's going to happen by taking time. And I had to drag you across this spectrum of time for a reason. If you look at price action with a single mindset that there's someone out there that's trying to knock you out, there's someone out there that is an adversary to you, someone out there is trying to collectively work towards you not being successful. If I sell that to everyone when I first meet them, they plug their ears. This guy's a conspiracy nut. He doesn't know what he's talking about. He's not responsible. He's blaming someone else. And I'm the only one in the whole room that knows what the hell's going on. I'm the black sheep of the whole fold. And I got no problem being that, because all the other lambs are getting slaughtered. I'm still here 20 years plus, and I'm going to be here, hopefully, Lord willing, 20 more years. Where are you going to be? Are you going to be in the same mindset as a trader, trying to figure out what the next guy's doing, instead of saying, I don't give a shit what the next guy's doing. I need to know what I'm going to be doing right now, and I'm going to move towards making it better for myself. And that way, as long as I know I'm thinking the way I'm thinking independently, if I'm wrong, I'm not going to second guess I'm wrong. I'm going to know right away I'm wrong, and I got to reevaluate what I did there and try not to make that same mistake again. Contrast that with following someone, copycatting their trades. The guy's wrong. 90% of the time, he's not going to admit that he was wrong. He won't even admit to it. He'll he'll gloss over it, or if it's a bad thing, like he loses the account or busts it or does something really bad, he just vanishes. See, that's the beautiful thing about the internet. People can pop up and be millionaires instantly. But the real people hang around, they prove it over and over again, okay, and they can take ownership of having screwed up sometimes. You miss an opportunity, you blow it, you get stopped out, things like that's going to happen. But if you are tied to someone like that, whether they're a good trader or not, you aren't going to come to the conclusion that, hey, look, this is wrong and know right away. You're going to be waiting on bated breath to figure out what they're going to say to give you the thought process that you should have, because you've already subscribed to them being the brain trust in the whole event. You didn't make the decision to take the trade. So all these components that we have out here as retail traders, all these ideas and methodologies and applications and processes and such, unless it gets down to the root principle of you making the decisions on your own, and it's going to be whether your mentor thinks something's going to happen in agreement or contrary to what you think, come hell or high water, you're taking that trade. You don't care what anybody else thinks. That's you. This is you, you're owning it, and I don't care what the outcome's going to be. It's mine, because only you can take the spoils from it or the lumps from it. It's yours. You have to own it. So when you look at price action, it's not just simply looking at order blocks. It's not simply looking at optimal trade entry retracements and fibs. Okay, it's not liquidity voids and liquidity pools, and it's not institutional order flow, and it's not just market maker buy sell profiles and fractal patterns and such. It's not animal patterns, harmonics, none of that stuff. It all gets back to this one thing. Okay, and I watched a video I think it was a year and a half ago. Every time you watch my videos, you get these little things that pop up as suggestions. And Jason Stapleton had one up on the side here. And I don't know why, but curiosity, I clicked on it. And he was talking about the one thing. You're all looking for that one thing, and it doesn't exist. Well, that's bullshit. It does exist, okay? And I'm going to tell you what it is right now. The one thing is having your alignment with institutional perspective. But because all of retail trading educators teach with a retail mindset, it's alien to them. It's alien to them. And that's why they stay in the education capacity. They market, they sell, they make business profits on selling education, because it's a wonderful opportunity to be risk-free. If they don't make money for a subscriber base, they'll leave, but they'll have the P.T. Barnum effect. Someone else will come behind them and believe their horseshit. Okay? So and I'm not trying to just pick on Jason, it's everyone really. The idea of selling this idea that there's not this one thing because you don't know what it is, it just shows with blinding, clarity, really. It's not blinding, it's clarity that they don't know what you're learning. What I know for certain, there is a method how these banks operate, and it repeats all the time. There's small little variances when it comes in and out of effect, okay? But by far and large, you're going to see that these things repeat themselves all the time. And if you spend your time trying to align your thought processes with how the banks would want to knock individuals out, why would they want to come back here and run this high if the overall premises is going to go lower? Because it's going to be for stops. Well, that means when it's running up here like this, okay, maybe get short. Maybe look for a smaller time frame, 15-minute turtle soup over in here. Expect an unwillingness to continue higher. But because we saw this idea fleshed out on a daily chart, it's going to be a lot of range still on a 5-minute chart, which is the reason why you guys get dusted trading on 5-minute charts without a higher time frame premise, because the daily chart can trade a little bit past what you think it can on a 5-minute, and sometimes 100 pips or more. But unless you go through the process of studying the higher time frame down to the lower time frame, not the lower time frame up to the higher time frame, Okay, it's the higher time frame down to the lower time frame. This is why I say, and I want to make this very clear, because the one person I do respect in this industry is Chris Laurie, but I've been very candid about how I do not like the trading, the volatility against institutional order flow. I don't like to do that because new traders, they don't have that understanding, and they are going to invariably take losses. And while that is educational by its very fact that they're going to take a loss and they're going to hopefully look into why they took a loss, I know that new traders don't go through demo trading for months. They maybe open up a demo account to see how to put a buy sell order in, and they made $3,000 in 5 minutes. So now they're going to put their whole checking account in their trading account, and they're going to dust it really quick. I just know human factor is they're going to rush to get into trading live. And while I do believe the exercise of trading volatility is just that, it's an exercise applied correctly with institutional order flow, it is wildly, wildly profitable. So I want to make that distinction. I've said it on record a couple different times where some have taken it. I think Chris maybe one time said it in Twitter, and I think it was a veiled response to me because it says there's some groups that say, you know, we shouldn't trade this way, or don't stand in front of a train, because that was actually the analogy I used. I don't want to stand in front of a freight train. You know, if I see a primarily bullish market environment, I'm sure as hell not trying to get short in any capacity at all. I don't want to do that because the largest expansion is going to be on the upside, and I want to hopefully be positioned for that expansion. So when we look at 4-hour time frames, okay, you can use all those ideas of trading volatility, liquidity pools and liquidity voids, and optimal trade entries, and stop runs, and turtle soups. All that stuff can be incorporated, but it's best utilized when you can ascertain the institutional order flow. Okay, now watch. I'm going to put this into an example of what it means and why these levels are highlighted like they are. The reason why I like this down candle, you thought I forgot about it, didn't you? The reason why I like this down candle is because, number one, it's a down candle, which I know is buying on an institutional level. Okay, and I know that is true after we see the range expansion and it engulfs this candle here. Okay, now granted, you're probably saying, well, that's wonderful, it's already moved. Yeah, but you're already going to anticipate it because it's below this old high. The trend is up. It's a daily chart we looked at earlier, and it showed that it was moving higher. We were just in a larger consolidation. But because we're looking at a 4-hour time frame, the moves that are going to be around the levels we're talking about are going to be dynamic. They're going to be explosive. They're going to be market maker 12 setups. What? Yeah, this is how it works. When you see price action on a daily and 4-hour, okay, you want to know where price is going. Where's the next setup? Is it going to be a big move, or is it going to be a scalp? How do I know if it's a day trade, and how do I know how to hold on to a move? When do I hold on to a close, and when do I hold on to a larger price move? Well, they're all answered with the daily and 4-hour. Watch. The down candle, we would have anticipated this becoming a buying opportunity right in here, right when that candle formed, right here, with the expectation that it's going to run this high. Why would we expect this high to be ran? Well, we almost got equal highs. To me, I call this equal highs, okay? Double tops. Okay, there's going to be a lot of liquidity resting above that. By itself, that's enough. But what's wonderful is keep going over here. Bingo. Void. You can use the low of this candle or the low of this one. It doesn't make a difference. It's both above, or they are both rather, above this high, which is another reason why this is going to be expectation for price to move and start surging higher. Okay. Price does, in fact, run through it, continues making a higher high, and trades up into a level. All this right here was that bearish daily ICT order block. In other words, we expected selling up in here. Okay, just go back in the beginning of the video where before I started talking about all kinds of other stuff, we had all this mapped out for the 99.50 to 99.20 levels. Remember that? That's what all this is in here. Okay, and then we further marked up this ICT breaker. Watch what happens when price is coming down. say you were fortunate enough to catch the sell in here based on this bearish order block, and you caught this move. When price trades down into that, you need to take some profits. Okay, take some profits. Don't expect it to steamroll right on through and keep on cutting through all these levels. There are going to be bounces in around there. Okay, you need to expect that. Also, notice that because of this down move, okay, and then price surges away, what do you apply to this model in price? Market maker sell profile, because we anticipate a selling event up here, but until it can create that sell scenario up at the 99.20, 99.50 level, it's got to trade up to it, right? So overlay market maker sell profile, consolidation, it rallies away, reaccumulation, smart money reversal, low risk sell, sells off, and then redistribution. Where's it going to go? It's going to try to run below these lows that started the consolidation, which led to the beginning of the market maker sell profile. But let me get to this point first. We know selling off here, the likelihood, where's it going to reach for? Back down to here. Why? There's a lot of orders down there, and it's in a primary uptrend still. So even if this is going to reverse or on a longer term scale like we anticipate up here, buying it here and filling in this void here, or returning back to this breaker, look how much range is there. We're going to use the very high, so we're going to get the best case scenario for low entry. I didn't say that right, did I? The lowest potential profit, let's say it like that. Okay, all the way up to there, it's 84 pips. Hello, 84 pips. Who don't want 84 pips? I've been doing this a long time. I still take 84 pips. There's an explosive move. Trades into it, you buy it. Now, the rest of the world isn't going to see that as a buy. They're going to be like, what the hell's happening? The dollar's crashing. They're not going to see that as a buy. But when you buy it, what are you holding for? A return to the breaker. And you're going to take some profits there. Do you anticipate continuing trading through? No. Why? Because the 99.20, 99.50 level is a daily bearish order block. So you want to take your profits there. Now, guess what you can do? You can go short. What's the setup? What's the explosive market maker 12 setup in this instance? Selling it at the breaker, reaching for the liquidity below the low here. It's that easy? Yeah, that's all it is. It's all it is. Why should it do that? Why should you expect it to do this? Well, we've already mapped out the idea of the breaker, why it ran up here. It took the stops. Overall, it's willing to go lower. It shows the willingness to go lower. This is a reasonable area to bounce. Why? Because there's old order flow back here. Sell it. But now watch what happens. The orders that they bought here and the orders they bought here, down here, they're underwater. Oh, that's going to be useful, isn't it? How will we use that going forward? Well, we'll look at it in a second. Going short here, up at the breaker. Just getting the old low down here. It's 97 pips. So we have 84 and 97. Basically 200 pips. Two setups, one market, all inside of a day or two. The market runs down below the low, then comes back up, trades into the body of the candle here, sells off. Where's it going to reach for? What's it going to reach for? Remember the last couple live sessions I did I think it was last week. I'm so out of touch. I don't know if it was last week or week before, but I did a couple live sessions, and I taught that there's primary questions you need to ask. It starts with two of them, really. Where's fair market value, and where's institutional order flow most likely going to take you to? Where's liquidity? Okay. Well, price had been going higher, right? So below this low is where stops will be resting. Once we cleared out this area here of this order block, it's been violated here. The only other level of liquidity below the market is here. You do have this bearish candle, which is an ICT bullish order block, but you have to look at it in context of where we are on the grand scheme of things, because up here we framed out the idea that the daily is suggesting lower prices. So these bullish ICT order blocks or down candles prior to up moves should do what? Should they hold or should they fail? They should fail, because the higher time frame daily is going to have a lot more effect on, and we're going to talk about this in the cable trade as a closer, this should fail. So it gives you a little bit of prognostication value when you're looking at order blocks. When should you look at a particular order block over another? Well, the idea of 99.20 and 99.50 up here on a daily is suggesting lower prices. And we gave up a key level here, okay, because this is crucial, because we took out this level here with it, and then we violated it here. Then we're unable to get back above the bodies of the candle here, mitigated, and then traded down. We blew the liquidity out here, took out the stops. So where would the next level of liquidity be? Below these lows. Equal lows, okay? So when price starts to rally up, what's it rallying up to? Well, we went back to this level here, mitigated, old high. Should there be a selling indication? Well, we'll see. Price starts to slide down. Okay, so now we have indications that they're selling more. So go back to the up candle. Now here's where we got that same question earlier. Michael, when do you use the bottom of the candle, the wick, or the body of the candle? When do you do that? Well, let me ask you a question. Looking at this candle, is this a big beefy candle or is it a small bodied candle? Clearly it's a big beefy candle. It's a big bodied candle. So this is when you use the body and you use the middle of it, okay? The mean threshold. You take your line, you draw it on there, right there. Okay, see that? It's the midway point of the body, not the wick to wick. That's not what we're looking at here, guys. We're looking at the body of the candle, and it's right in the middle. Okay, so let me highlight that. It's a little bit of a different color, because I want to make a strong distinction between it and the other lines I have on here that I don't want to remove. Yeah, it's just going to have to work. All right, so price shows a willingness to sell off here. So now our thinking is this. They sold it here. Above the halfway point is liquidity that's too thin. Don't expect that to be rated back into, okay? Expect the middle point down to the bottom of the candle, okay? So what am I saying? I'm saying that we need to take this into consideration. Right there. And that's how your bearish order block would be based on this market action in here. Let's take this fib off. So when price trades back up into it, this is where you sell, right there. Where do you sell at? Well, the low on this candle, low comes in at 98.19. Well, right away we know 98.20 is inside that range. There's institutional level 98.20. We got 98.30, small round number, and we got 98.40. You see we highlighted 98.43. Okay, so we could sell at 98.40, 98.30, and 98.20. Depends on what you want to find on a smaller time frame. Dropping down in the smaller time frames, you'd have all kinds of other setups. But in here, that would be the sell right there. Okay, and what do you reach for? Where's the two things I asked you, or instructed you rather, to look for when you're selling or buying rather? When you're looking for your setups, where's liquidity? Where's fair market value? Liquidity is where the market's going to be drawn based on institutional order flow. It's going to seek out liquidity. And where's fair market value? Okay, watch. The down candle prior to this upswing that led into this sell in here, that's fair market value right there. Price, you sell here, you get out down here. Simple enough. Now, if you have a strong conviction that this is going to be a longer term high, you would just take some profits here and leave some on. But because we're in what? A primary uptrend or downtrend on the dollar? Are you trying to catch reversals and hold for the very high and hold it for multi-year? That may be what you want to do. I don't do that. You got to be aware that there may be another deeper legged buying opportunity for the dollar. And I've been calling $5, $2, $5 on the greenback for over a year. And I still believe it's possible to happen. So looking at that, selling in here, this is the selling it up here. We'll use the 30 level, halfway of that range. And just getting down to this level here is 80 pips. It's a little hard to see it. Yeah, right there, 80 pips right there. So again, explosive price action, trades down, and then look what happens. It trades back one more time, boom. Take a look inside this beefy candle. Now again, are we going to look at the bottom of the candle and use the wick only, or are we going to do what? We're going to break down the mean threshold. Big beefy bodies, we do what? We measure the range of the body of the candle. You don't see this anywhere else. So it's not repackaged, it's not regurgitated. And then you take your line, place it right on the 50% level, which is all I did was highlight it again on the fib level. Calibrated it and said just to show equilibrium. Thank you, Peter, for showing me that I spelled or misspelled equilibrium wrong. The price action moves right up in here. Now look at the buys. It goes just a little bit past the halfway point, but look how it respects it. Now, yes, it wicks through it. I'm not going to argue that it can do this. We said this before, it can do that. But the bulk of the volume, which is always indicative and seen through the bodies of the candle, not the wicks. The wicks are going to always be the thinnest price action. It's reaching for stops. This high here, it runs through it and then rejects it. You see that? Now, when you see this, the next question is what? Is this a liquidity void? From the low down here, when it started running up like we did here, we did this buying opportunity here where it runs up. We are in a consolidation. Okay, so the question is did we blow through these highs? No, we weren't able to blow through the highs. It's starting to break down. So the question is what? Where's liquidity? Below the lows. So market, if you sell it here, you want to reach for a move going below these lows. The market will look to take that liquidity out. That's these lows right here. And it does it right there. Then this run down to get those stops creates an opportunity. This up candle inside of this void, price comes back up, trades up into what? Small little bodied candle. It's not a big beefy one, right? We don't even use the fib now. We do what? We use the wick to the body of the candle. I already see some of you smiling already. Oh, it's making sense now. See that? Aren't you glad you paid for this with PayPal? Best money you ever spent. Trades right up into the dynamic resistance. This ICT bearish order block right in here, midway point of it, in fact, also, and sells off. Wonderful, isn't it? So you have to have a storyline behind what it is that you're trading and why you're trading it. You got to be looking for the liquidity in the marketplace like the banks do, because they're pushing price and they're buying and selling to drive price on a short term to manipulate price action. Okay, because they know by and large, if they manipulate price to a certain price level, they know there's going to be a whole lot of injection of action. Okay, and that will drive their price moves further. They may have more interest to sell higher, but they'll buy short term to push price up just so the market price will print at that level, knowing that the funds which use stops will be triggered into the marketplace or out of the marketplace respectively, and giving them the counterparty to the trade. The smart money or banks do not see your stops. Okay, I am not teaching nor have I ever seen myself ever present a case that the banks see your retail stop in FXCM. They don't. They don't see Oanda's. They don't see eToro. They don't see whatever else these retail brokers have, because they're outside that interbank level. They're inside of a small little children's pool of liquidity, and there's a big vast ocean out there that great big old sharks swim in, and they know that the seals, they hang out on those little icebergs, and they're going to be right above the highs and right below the lows, and that's where the stops are. And they're just going to come in just like a killer whale. They'll run up on it and knock them off and just eat them. So you either elect to be a killer whale or you stay a seal. There it is. There's your analogy for today. So let's take a look at the cable and wrap this up, because my stomach's growling. I'm hungry. Surprise, surprise, the cable's lower. I'm not sure how that happened. Maybe because we said it was going to happen. Arrogance. All right, so we have the cable running lower. Let's take a look at what I shared on Twitter real quick, just for continuity's sake before we get into it. I shared a couple levels on Twitter indicating specific lows, and the low comes in at 142.29 on this candle right here. Let me make sure I'm getting the right one. Yeah, 42.29 is the low. I mean, I'm not going to be able to get it like that. I got to set it up. I can't see your comments, but I promise I will scroll through it later on to see it. But I'm hoping that you guys are learning something today, because this is it really is higher level stuff. I mean, when you learn these types of things, it's not indicator based, it's not mathematically derived, it's the psychology of the marketplace, and the institutions are the marketplace. Retail is not. We're fleas on a big dog. So there are the two levels that I tweeted, 142.29 and 135.10 respectively. These are the levels here. And because we are in what type of market profile? What market profile is this? Is it range bound, trending, reversal? Which one is it? Range bound. So in a consolidating market like this, the market will do what? It will seek liquidity above and below the marketplace. Well, we saw that happen here. It took out the old highs, and we traded down, took out these equal lows, and then look at the nice little reaction here. This is a monthly chart, okay? It took liquidity out and then rallied up several months and then rolled back down. See that? Look closely. What do you see there? Right in here. What do you see right in here? Now I'm going to go to the questions section, because I want to see if you guys are actually saying anything here that answers my inquiry. Whoa, I just got some long-winded, I definitely will have to be reading some of these statements after we close. There's a lot of them. Let me scroll this out of the way. And if you look at, hang on one second. Okay, sorry about that. My 16-year-old just came home from school. He does a part-time, works his job that he has to have for credit, and then he has 2 classes in a day, so he comes home midday. Just want to make sure he didn't come in and hollering, "Oh, Dad." So we have a consolidating market, okay, and we saw price take out the highs here. Let me just draw that up so you can see how it was. Very good indication of a turtle soup. Comes up, bloop, hits it, and rolls back down. Where's it going to reach for? Liquidity, fair market value. Okay, so price clears out these areas, stops, and then it bounces up. Where's it bouncing up to? Well, it ain't going all the way up here. There's no need for it to do that because it gave a reversal inside of the consolidation, okay, because the profiles can nest. We have a consolidation. It takes out the stops, okay, and then runs down. If it's reaching down for liquidity below the marketplace, it does it here, but there's no necessity for it to come back up to that. But look close. Look real close in here. What do you see? I'm actually waiting for a response from some of you. See that? This is the same thing that I just described in the dollar. See the old high here? Down candle right below the old high. See that? What's smart money doing here? Obviously, in hindsight, we can see it. But if you go back in my market reviews, we were calling this thing higher all along. And it's all in video. And I know you guys have them recorded and downloaded to your computers. Call me bullshit on Twitter if I'm not being honest. But I'm telling you, we were long all through here and calling for this old high. But the smart money is buying on a down move like that. Okay, this is a monthly candle, a down candle. Okay, so the buy orders that they have here have to be mitigated if it's going to go lower. They bought it. This is how long-term, no stop loss holding type thing. They held on to this position. It's multi-year. Multi-year. You're not going to hear this stuff taught in retail circuits because they don't know it. Banks can sit on long positions, macro view perspectives. Okay, they can sit on those positions. They're hedging. That's one of the benefits they have that we can't do that in America. We can't hedge because once people knew that they could trade like this, you never lost. You never took a loss. Not a net loss, let's put it that way. I mean, positions would be underwater, but eventually you could work your way out of it. The breaker right in here trades right back up into it here, rolls over, and then does what? Reaches for the liquidity below the market here, and ultimately it still and is going to take out the low here. And if it gets a lot of steam, which I expect I personally expect a bounce of significance in here. I think it's going to be a sharp reaction when it trades at that level. But if it continues to just mow right on through it, it's going to aim for this low, 135.02. No, what am I saying? 135? Is it 135.02? I don't think I did the price level on that. The low 135.03. So yeah, I have to set this 135.03. At least for this feed. You'll have to do it for your own individual platforms to get your platform's price feed for that particular low. And the low I'm referring to is the January low of 2009 and in the low of May 2010. There are the two levels that I suspect that cable is gunning for. Okay, and looking at a weekly chart, okay, we see price. Let me get this. If you're saying anything, I'm not going to be able to see it, so I will open up the window in a minute where you're commenting or questioning, but I can't see it for the next couple minutes. The equal lows in here. Okay, price swept below it. You can see that very handsomely done here, and one more run below the low it created here, and then rallied up rather aggressively. Where is it reaching for? Fair market value. Sell off. Big candle. Use the middle of the candle, mean threshold. Sell off. Small little body candle prior to the big move. What do you use? The wick to the body. sell off. Small little body candle for the big move down. What do you use? The body to the wick. Extend that out in time. You see all that distribution in here? Sells off. Okay. We have a small body candle right before a big candle here. Use the wick to the body. Sell off. Price runs down and starts to break hard, taking out the lows here and reaching for the liquidity resting at 142.29. We go down to a hang on, I got to remember what I was going to say about this. Hold on. Oh, the most recent trade this did in cable. Good grief. Here's the daily. Okay, and price, we talked about it being selling or a selling scenario up in here. Okay, if you look at the beginning of December, I gave you, I believe it was a live session. I know it's recorded because it's out there, but we were talking about the market going lower here, okay, and potentially reaching down into this order block, and whether we have the momentum to go through this low or not would have to be seen at that time. I think it's the actual term I used and the way I was describing it. And obviously you can see it is rolling in this steamrolling down. I went short. Make sure I got my price here. I sold it and yeah, I had a New York session trade selling short at 143.92. 143.92. So let's go into a 15-minute time frame. And show you what I want to show you. 143.92. Now, I don't have this MT4 demo account linked to the one to MyFX. Otherwise, I could just very easily just pop it up there. The one I use that for, I do it with my iPhone. So you're just going to go through the MyFX book and confirm everything I'm showing you is based on what you see here. So where are we at? And 1307. All right. And it's on the wrong day. Okay, and time is right here, indicated by the arrow. And we actually, it could. I mean, I'm not saying it will, but I'd like to see it drive down and hit that level live. That'd be awesome. That's a little bit of a range today. Not that it can't do it, but it's still reaching. We're in London close now, so it may not have the gas to do it. But we have price trading right in here, okay? And I want you to look close. This is the candle right in here I traded it at, right there. The big one that rallied up real strong. Let me zoom in. My stomach is really, really growling. I didn't eat breakfast today, and I'm regretting it now. So here's the candle, right? Good grief. There it is. Okay, this is the candle I went in long on, and I want you to look at what you see here. Zoom in one more time because this is very, very important. We have this big rally up, okay, a big old rally, and price comes back down and slams right into this. What is this? Now let me pull up the question segment. Well, I forgot to take this off. Okay, right in here, price comes back down into this liquidity void right here and fills the range from here all the way up here. It comes right back down. In other words, it looks like this. There's the range. It explodes up, takes out the stops here, rallies a little bit more, and then starts coming back down, okay? And slams right into it there, right there, okay? Right in this candle, okay? I'm thinking now there's a tug of war on the setups. This time frame is a 15-minute time frame, okay? And it's exactly what I had on my phone. Mike, I know I'm not saying I bought it. I never said that I bought it. I'm explaining something in contrast so you know the benefits of why I did what I did. I never said I bought it. The market rallied up here, okay, and it came right back down to this level right here. What is this? What's this candle right here? Bullish order block. No problem, no problem. I appreciate your enthusiasm though. The fact that we saw a rally up like this, okay, and a down candle in normal market conditions, okay, if this is a bullish environment, this is exactly what you would expect to be a buyer. Okay, this is exactly how you'd handle it. It's in New York Open, okay? It's a wonderful setup, and I went in with the idea showing, and it's one of the exercises I also teach, that you have to test one order block against another order block. And this is the only way you start to appreciate the higher time frame, okay? We're going to look at the higher time frame in respect to what we're showing here, but I want you to see what I traded short right into. On a very, very short term, this was screaming a buy, but it was a very short term time frame setup. Nonetheless, it could have paid out handsomely, but it's still a short term setup. I went short right at the time it was most bullish on a very short term basis. Watch what takes place. Rallies off strong. Where's liquidity? Above the high, right? Does everyone agree the liquidity would be above these highs, or this high rather? I'm waiting for your response. You guys there? You still there? Can I get an audio check? You guys there? Hello, hello, hello. Can you guys hear me? I'm waiting for a response from one of you guys to let me know. Thank you very much. I'm not sure what just happened. We had our lights just flicker, and that our connection from Comcast just was briefly cut. All right, so I'm not sure how that's going to affect the recording, but if we're still talking, let me make sure it's still going. Yeah, it's still recording, so you didn't miss anything. All right, so as price is running up, do we agree that as price is rallying, the liquidity is going to be above the high here? Right, so we know price is most likely going to run up, try to reach for this high. And price runs and takes out the high right here. I sat through all of this without a stop loss order, okay? Without any protection whatsoever and no limit order for profit objective. This is one of the things I want you to do as well in your demo account. This is how you use the demo account, okay? You want to see the effects of buying and selling at higher time frame and lower time frame order blocks, and you'll see the reactions of it, okay? And by doing that, it will give you input that you'll use for future trades in either a demo account if you're still in the development stage or in live trading. My question is this: how could this be used as positive reinforcement, even though it's in a demo account? How is this beneficial to you? By taking an exercise like this and being short here, how's that beneficial to you, seeing something like this when it runs out like that? How would that be beneficial? Well, yeah, Nino, that's good. Trusting, okay, trusting that you're able to see reactions and moves before they happen, okay. But more importantly, if you do get caught up and you take a trade and it starts to scream against you, you have to know where it's most likely going to reach for. And if you're able to take the risk on, and weather that, okay, and this is another reason why you keep your risk small, because if you're only risking 0.5% or 1%, you're still within the realm of absorbing something like this. Now the question is do you continue holding on to it if it's rallying on through it? No. But if you are willing to absorb the move up to here and still stick to your overall convictions that it's going to trade lower, this is what you would take from it. Okay, but I want to show you the contrast between seeing a short-term 15-minute bearish candle, which is a bullish order block, seeing the reactions of it like that, but still staying in the move. Yes, Brian, you could have sold here on a turtle soup. Yes. Okay, so price comes down and starts to roll. What do you see here? Right here. Man, I am starving. Look at the reactions in here. See that? Middle of this up candle. Look at the buys of the candle right there. Sweeps in just a little bit above it, but ultimately starts to sell off. It runs, reaching for the order block right here. And that's where we're at now. What's this? Bearish order block. It's an up candle though. Who sells in up candles? Smart money. Banks. Deep pockets. People with more money than ICT, that's for sure. Body of the candle. Equilibrium. From the low up to the midpoint is where you want to be seller. Right in here. Right there. You want to be a seller in anywhere in this area, and only if it's in a time zone that we like to trade, which is ICT kill zone for London and New York open or London close. Okay, so have I satisfied the inquiry about why I go back and forth with when I use the wicks and when I use the bodies? Okay, if anything else, if nothing else, rather, at least today we've answered that and wasted enough of your time doing it. Yeah, that was the point of the last cable trade. Obviously, we know that the last couple of times we talked live, we were calling cable lower, using a higher time frame setup, holding onto a trade and taking profits before, because average Joe's still in his development stage. He's trying to learn and trust the order blocks and such. So I'm kind of give you a real timeline on what to expect, what would be considered normal in my opinion, and then you'll start seeing in a couple of months, you'll see the stark contrast to doing things a lot more systematic. Could you comment on dollar bond decoupling? Yeah, it's something I'm not following at this time because I do believe the interest rate markets are about to crash. All debt instruments should be not traded right now. They're going to put a whammy on everyone, and that's one of the reasons why I don't trade bond futures. And I just think that anyone in the debt instruments right now shouldn't be. A Forex Ltd. Forex Ltd. Larry, Tom, Dick. If you do a search on Google for MT4 platform, Forex Ltd., they have the dollar index. Yes, Patrick, it's being recorded. The correlation between S&P and currencies. One that does really good with S&P is Aussie dollar. Do I always use SMT for confirmation or not? 99% of my trades have some measure of an SMT attributed to it, yes. Why do they manipulate the dollar when so free retail traders trade it? Well, it's not that they're trading the dollar per se, but they're trading against it when we're trading all the pairs, the majors, like the pound dollar. If you trade cable, you are trading the dollar. You're just trading it short. So the dollar is a barometer, in my opinion, much like the stock indices are, like the Dow Jones, NASDAQ, and S&P 500. If the overall trend of the general market, and the way I deem that is the health or strength or weakness of the overall market, can be discerned by looking at one measure or device, which being, in my opinion, the dollar. If it being the dollar is poised to move higher, that's like one of the best scenarios for being a short seller for foreign currencies. And it's really simple. It's not like rocket science, but it's one of the things that's very often mistaken for its effectiveness or importance. Okay, if you're looking for SMT divergence, or if you're looking for correlated pair SMT divergence, okay, I didn't want to do this, but it's really good that I do it because it's going to be a problem if I don't. Euro pound, I'm just curious, did anybody else expect this to go higher? Did we not call euro pound higher? We called this bad boy up. Okay, so when you look at this, and this is what makes foreign exchange difficult, admittedly, but when you understand it, it works in wonderful concert with three currency pairs. The dollar always has to be a factor in your trading, okay? And based on what the dollar is doing is going to be insightful in what you do with your foreign currency trades, okay? The dollar is, in essence, in a consolidation inside of a larger uptrend. Would everyone agree that that's the case? Okay, so we are in a primary uptrend with a dollar in a consolidation. So they're holding dollar. So by holding dollar, that gives the freedom for the other foreign currencies to move rather strong. Okay, so there is two conditions that take place, and you can have the dollar trending lower, which would be a trending market, higher in the foreign currency markets. But if they hold dollar in a consolidation, you're going to see very strong and sharp moves in foreign currencies. So there's a market maker 12 tip for you. If dollar is in consolidation, okay, it's in a holding pattern, that means that the accelerated moves are going to occur not on the dollar side of the currencies. In other words, like how would I say this? Like the British pound and the dollar. Okay, the British pound is going to have a lot more freedom to move versus the dollar seeing respective move. Like we see the cable. Let's go over to the cable real quick. Okay, cable is moving right along lower, continuing its primary downtrend. And looking at it, it's got a lot more freedom to move lower in a trending environment, whereas the dollar is in a holding pattern and it's still stuck in its range, respectively. See that? We're going sideways, while the cable has freedom to go lower in a trending move. Okay. Now, for the euro, let's go over to a 4-hour chart. Now, I know I'm going to open up a Pandora's box with all this because it's something I can't teach in one sitting. But euro is in a holding pattern as well. You see that? We're in a very large consolidation, in which we called this well months ago. earlier on in the beginning of last year, we said that when we get down to these levels, it may go into a larger consolidation and trade sideways for a long period of time. It's in video. You can go see it. It's there. Now you're probably saying, well, what's the big deal? Who cares? You can't make money in that. Well, yes, you can, because if you're in a large consolidation in the euro and you're in a consolidation in the dollar, okay, think about what you got here. If you have a piece of paper and a pen, and if you don't have one, shame on you because you're watching a video with me live. You should always be taking notes. I want you to take on your piece of paper in like a triangle formation, okay? I want you to write the dollar at the center of your piece of paper. Lower left, I want you to write euro. In the lower right, I want you to write British pound. Okay, so you have the top of the triangle is the dollar. The lower left is euro. Lower right is the British pound. Right now, dollar on a 4-hour basis is consolidating. It's in an uptrend, but it's consolidating. You see that? So you have to circle the dollar. The euro is in a consolidation as well, in a primary downtrend. So you need to circle the euro. Now watch. British pound is trending lower. It's in a trending environment. Okay? Now, I don't know if you ever studied fractions or whatever in school, but if you didn't study fractions, this is probably going to be a little tricky for you, but it's really simplistic when you understand fractions. The dollar and the euro are in consolidation. They're in holding patterns, okay? The cable is being permitted to move lower, okay? The British pound is dropping while the euro is sideways to up. Now, in those environments, people like Steve Morrow, which learned my stuff partially and ran with it and tried to make money doing it, I never explained all the things that you're learning in Market Maker 12 or in Market Maker series really until I just recently started doing it. So that's the reason why when you watch his horse shit on YouTube, he'll say that correlation doesn't work. Correlation works perfectly, but you have to understand why the banks are doing what they're doing and holding certain currencies in consolidation to allow other currencies to run. And it's done by manipulating the whole board or working the crosses. And what I mean by that is we have those 3 currency pairs there, okay? Not currency pairs, but currencies. You have the dollar, which is the king. It's above everyone else. Euro in the lower left, both euro and dollar are in consolidation. Cable, or British pound, is allowed to move. It's been trending lower. It did not enter into consolidation. It's trending lower. Because the cable, or British pound, is in a trending environment lower, dollar is in consolidation, and fiber is in consolidation, that means the trade is going to be in what pair? Draw a line connecting euro and pound on your chart that you just drew or a picture. Connect euro and British pound. If cable or British pound is dropping in a trending environment and euro is being held, what reaction and price action, what direction would that indicate, or what you would expect to see in euro pound? What direction should it go up or down? Now, you want to make millions of dollars? These are the types of setups that you look for because they happen a couple times a year. They are unbelievable loaded deals. I mean, it's like they are so telling that you can't miss it, but you have to understand the dynamics behind it. Otherwise, it'll completely be oblivious to you. Now, for those who are just watching this for the first time, it's going to sound like, well, of course, now the euro pound's been rocketing up. I mean, it's been going up for hundreds and hundreds of pips, Michael. Of course, now you're going to come out and say this stuff works like that. Well, if you were with me at the beginning of December, I was telling everybody this thing was going to roll and roll and roll, okay? And where we're at is euro pound. I know I got this here. Here's euro pound, and let's go over here. Excuse me. We have the market trading down into what? What's this right here? Bullish order block. Who buys in down candles? Banks. Okay. We have a small little range. What makes it a small range? Look around it. There's bigger ranges and there's a smaller range. This is a smaller range in contrast to the bigger ranges. Okay, all I did was use something I learned from Larry Williams, my mentor. Small ranges begot large ranges, and large ranges begot small ranges. Okay, so this is a smaller range. I'm going to use the wick to the body, and we're cutting through candles, guys. So throw all the supply and demand horse shit out the window. You got to go through the candles and find out where the primary, the parent price swing starts here. Okay, they come down and dip into the order block here, but what time frame is this? Daily. Daily can eat into that order block, especially if it's going to be a sizable move. Right here you go. Boom, takes off. Now think. What do you see here? They're all flashing. It's a market maker buy profile. Down into an area of being a buyer. Okay, the mechanics are dollars in consolidation, euros in consolidation. We said euro was most likely going to go into consolidation before it went into consolidation. How did I know that? Why did I say those words? Because I study market profiling. And I'm not talking about market profile where they have all those bars vertically along the horizontal, horizontal lines, I guess, showing volume or whatever around specific price levels, which I don't have any faith in. Okay, when I say market profile, I'm talking about, is it in a market trend? Is it in consolidation, or is it reversing? There's 3 market profiles. Okay. JP, I think you're probably the only one that can't hear me. So if you're hearing this in the recording, understand that everyone else is able to hear me. So it's something that's limited to you. But we have the euro pound free to rally. Okay. And if it's going to rally, how far is it going to rally? What's the structure behind all the rallying that should take place? Well, we have a consolidation. Market drops down into an area of buying. Smart money reversal. Low risk buy inside of a bullish order block. Rallies off. Reaccumulation takes out the top of the consolidation. If you see trades like, well, you can do the same process with the Kiwi and Aussie. Okay, you just look at the price action between the dollar, the Kiwi, and the Australian dollar. Okay, and the same thing you can do with the Japanese yen, euro, and the cable. Just replace the dollar with the yen, and you look at the difference between are you seeing the yen in consolidation, or is it trending, or is the euro consolidating, or is it trending, or is the pound you're consolidating or trending? Okay, and by having those 3 on there, by seeing which ones are being held, the other one's going to be freed up. They're only going to hold 2. Okay, they're only going to hold 2 in this triad. Now, when you're looking at 2 pairs, okay, because you can have correlated setups like this as well, where they'll hold euro sideways, okay, and they'll run cable, and they'll run dollar. So there's a little bit of a thing that has to come by experience, and that unfortunately is going to have to be worked out by you. Okay, and it's a knack type thing. It's an experience thing. I wish I could say this is what you do every single time, but it's just an experience thing that you have to build in your own trading. Okay, but these are the building blocks how you get to it, because like I said, I can't see where the orders are on the banks. I can't see them really. Okay, I just know how they're most likely going to be layered into the marketplace and where they're most likely going to reach for based on that. And if I start seeing signs that a particular currency is being held in consolidation, they're only going to hold a currency in consolidation to allow the cross to move. And the easiest way to describe it is what we just did here with the euro pound. Okay, and how you use that sets up astronomical trading opportunities, where if you see it happening, and it's only a couple times a year it does it, it's not every single pair it does it, but there's a couple times where they set up like these mega trades, and when you see it, it's just like, man, it's so telling what they're doing. So I'm not sure where you are in your scope of trading, but if you could get into an area of taking a trade around the 70 level down in here, knowing that the likelihood is going to run up to here and clear out that, not even so much as this, say it just gets back to here. Okay, if you can find trades like that every year, just one of them, and you use your money management and your trade setups, if you can set up a trade down here with 20, 30 pips risk, well, let's see what it is. I'm not sure what it is really, top of my head. It's over 500 pips, and ultimately it's gone now to over 700 pips. They usually last several weeks to a couple months, because they're macro type events that's being set up when you're looking at a daily chart. Now, these same phenomenon take place on lower time frames too. Like you can see dollar being held in a small consolidation on an hourly basis, where euro is ripping and cables being held. Well, that's going to indicate the same thing we're kind of seeing here. It's wherever whatever currency is being allowed to move, if the other one's dropping, you got to look at how that relates to like the euro pound. Euro is being held, won't drop with cable, okay, and it's going the other direction or staying in consolidation. And if the cable's really tearing lower like we've been seeing, that's going to be 100% bullish for euro pound, because euro won't be going down with cable, it's going to be holding up, and because pound is the second in the currency pair of euro pound, it's going to allow euro to or euro pound to show appreciation going higher and not see it go lower. And it'll be dynamic. It won't be this little muddled, little slow increase over time. It's going to be like boom, 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 real hard. And like you see here, it's indicative that you see it right here. That's how you find explosive price moves. It's not seeing them both moving in tandem. You won't see these explosive moves like you're seeing here when euro and cable are moving in tandem. It can't happen. It can only happen when one's being held and they're holding it to create these environments like this. Does that make sense? Okay. There's a lot of questions you guys are asking, and I really wish I had the time to get all over them. But the wonderful thing about this platform is it logs everything that's said to me in question format. So that way, if I don't get to your question or comment while we're doing the recording or presentation, it gives me an opportunity to go through it, and I can sometimes answer it in a future video, or sometimes as easy as a tweet. So if I didn't get to your stuff, or question or whatever, I apologize, but it really is a ton of them. I mean, there's so many of them coming, they're still flipping by. So yeah, so the recording is obviously recording still, but I will have to cut it here. I want to be able to make sure I get this recording out to you before I go out with my wife tonight. So give me some time to get it formatted. It's really quick usually when they format to MP4 with this platform, and then obviously uploading it to my my server doesn't take long at all. So I'm going to close it here. I'm starving, and I'm not sure how long we've been going at this, but it's been a couple hours, I think. But the 3 hours, thanks, Mike. It didn't feel like 3 hours, though. I was thinking like 2 hours, but it's 3 hours. Good grief. Well, I'm gonna, like I say, I'll close it here. This is not one of those videos you watch one time. Okay, this is one of those videos where you can listen to while you're driving back and forth to work a couple times a week. Okay, listen to me, because a lot of it's a lot of jawboning. Okay, only really watch it when we get to the charting stuff where we're actually talking about examples. But the first part of the video is really good commute discussion. If I offended you with my language, please just, it's not my intent to do that. But sometimes I just get a little passionate about some of the things I say, and the human in me comes out. So with that, guys, I wish you good luck and good trading, and give me some feedback on Twitter if this was insightful to you. Have a good week, and I'll talk to you next weekend. Well, actually, I said that backwards now. Have a good weekend. I'll talk to you next week. How about that? See you guys.